Hello guys, so how are you? Very good morning to all of you. Can you please confirm the chat box if the audio and video is clear to all of you? Come on guys, quickly can you please confirm in the chat box if the audio and video is clear to all of you? Come on guys, quickly. Yes, amazing guys. Amazing one. Okay. So now today in this session we will be practicing 24 good number of questions, 24 good number of concept based questions of the chapter group accounting. Guys, understand, we all know that in SBR most of the students are not able to clear the examinations. Why? Because they lack time management. Okay, and now when I was reading the last 10 attempts examiner report, all the examiner report had one thing in common. The examiner used to say that the students spend a lot of their time in answering the questions of group accounting and still they are not yet correct. And why does this happen? Because we as a student understand the concepts of group accounting. Okay, but after understanding the concepts of group accounting, we directly jump to the 30 marker exam level questions. What happens in this process? What happens is you lack how to apply that concept in the given case scenario. That application of the knowledge part gets missed. So now in this session we will be practicing 24 good number of questions. Now these questions will help you understand how to apply the knowledge that you have in the given question. So we will now understand in this class, in this session, we will now understand how exactly to read the case scenario, how to interpret the requirement, what should be the length of the answers that we should be writing, and how to draft our answers and how to manage the time. So each and everything we will be covering. Okay, the length of this session approximately in my understanding should be around 4 to 5 hours, but it can go beyond that as well. But whatever time it takes, the whole intent to take this session on a Sunday morning was to so that all the students, whether working professionals or not, can join and devote one full day. And trust me guys, just give me this 4 to 5 hours. I want to give something back to the ACCA community. You guys have given me a lot, so now it's time for me to give back to my community now. So I am taking this session entirely. I'm taking this session, and this session, if you watch till the end, I can assure you that you will get next level confidence in the chapter of group accounting. On this note, tell me, shall I start the session? Come on guys, please tell me, shall I start the session? I need a comment in the chat box. And guys, what is this? What is this? You guys are not liking the session? Please like the session, subscribe the channel. All of you, come on guys, come on, each one of you. Please hit the like button, all of you, come on. Please hit the like button, all of you. And then let's start the session with a bang. Okay, now. So let us start the session now. So I'll be shifting to the Excel file where I will be discussing these questions with you guys. Can you see the Excel file? Is the Excel file visible? Whatever is written in the text, is that visible? All of you, I need a confirmation from each one of you. I need a confirmation from each one of you. Whatever is written in the question, is that visible? And whatever is written is the Excel file, whatever I will be writing, is that visible to all of you in a properly? Can you please confirm? Can you please confirm? Is everything visible properly? Chalo. Chalo. Let us start solving it now. So I'll keep my iPad aside. I'll bring my this one in front of me, and now I will be reading the question and I'll be solving it with you guys. Where can we find the questions? The questions are shared in the WhatsApp group. The questions are shared in the Telegram group. Yes, you can download it from there. Okay. Chalo, let us start it. Let us start the session now. And guys, if you're watching it without liking the session, okay, very bad, very bad, very bad. Come on, guys, please, all of you, hit a like button, hit the like button, okay? Chalo, let us start discussing these questions one by one. And I need all of you to actively participate. I need all of you to actively participate in the class. All of you actively participate in the class. Chalo, let's read the question and try to solve it. Now, you work in the finance department of Robbie. Now, always understand the first rule of solving any question of SBR. The first rule of solving any question of SBR is you will not read this scenario first. First of all, directly go to the requirement. Directly go to the requirement. Okay, now what is the requirement? Explain the financial reporting principles that underlie the accounting of goodwill on acquisition of Hale. Tell me, are we required to compute goodwill? Come on, guys, tell me. Are we required to compute goodwill? No, we are not required to compute goodwill. See, is the question saying calculate? No, question is saying explain. Explain. So we are required to explain the accounting treatment of goodwill. So how exactly are we going to write that? Okay, so first statement itself we will write is what is goodwill? What is goodwill? Come on, guys, tell me what is goodwill. Come on, all of you, tell me please. What do you mean by goodwill? What do you mean by goodwill? So we'll write goodwill is calculated on date of acquisition. I'm writing in short form. You have to write in full form, okay? Can you drag yourself to the end of the screen? Okay, just give me a minute. Camera. I'll bring myself here. Is that okay? Not here. Or I'll make myself quite small. Right? I believe this is okay. I believe this is okay. Now, goodwill is calculated on date of acquisition at what value? As fair value of consideration transferred plus value of non-controlling interest on date of acquisition less fair value of identifiable net assets on date of acquisition. Okay, so this is how we compute goodwill. So first of all, we have written the goodwill. What is the meaning of goodwill? Okay, now what we have to do is we have to read. But before that, please understand, guys, what is the marking scheme? We have 5 marks for this question. So make sure that we are writing 5 good number of points so that we get 1.1 mark. 1.1 mark. Okay, now come on, guys. Let's read the question. So now the question says, you are working in the finance department of Robbie. Robbie has recently appointed 2 new directors with limited finance experience to the board. You have received an email from the finance director. And what is written in the email? On 1st January 20x2, Robbie has acquired 80. This is the date of acquisition. Robbie has acquired 80% equity shares. of HALE, obtaining control over HALE from that date. Okay, now the purchase consideration comprised cash of 50 million payable on 1st June 20x2. It is a cash consideration. 24.2 payable on 31st May 20x4. It is a deferred consideration. So what you will write here now? You will have to write about deferred consideration. You will have to write about deferred consideration. So now how will you write about deferred consideration? So deferred consideration, right? Deferred consideration is recognized at its present value on date of acquisition. Okay, now see, when we compute the present value, we have to do the unwinding also. So we write any unwinding effect of present value. See, whatever I am writing is what you have to write in the exam also. I am writing exactly in the same manner. Okay, any unwinding effect of present value is called as finance costs, and is recognized in consolidated profit or loss. Done, sorted. What's next? A further amount is payable on 31st August 20x6 if the cumulative profits of HALE for the 4-year period from 1st June 20x2 till 31st May 20x6 exceed 150 million. Can anyone please tell me what is this consideration called as? There is a condition attached. Can you please tell me what is that called as? It is called as contingent consideration. So let's talk about contingent consideration also. Contingent consideration, okay? Contingent. So contingent consideration is recognized at its present value? No, at its fair value on date of acquisition. Any fair value changes is recognized in consolidated P&L. Is that clear, everyone? Okay, so see, 5 marks, we have written 3 good number of points. 5 marks, we've done 3 good number of points. Okay, now that you have to write that point also. Calculate the present value. So present value, calculate the present value also. So present value of deferred consideration is equals to how much? If the data is given, we will compute the present value also. 24.2 will be payable after 2 years. Discounting rate is 10%. So it is 24.2 divided by 1.1 to the power 2. Okay, so which is equals to how much? 24.2 divided by 1.1 divided by 1.1. It is 20 million. Is equals to 20 million. Okay, now for contingent consideration, what is the fair value? 40 million. So fair value on date of acquisition is equals to how much? 40 million. Okay, now what else? Let's read the question further. On 1st January 2002, fair value of the contingent consideration is on 31st May 2003, fair value is remeasured at 42 million. So let's write that part also. Fair value at reporting date is equals to 42 million. Therefore 2 million will go to P&L. Okay, now further the notes to the financial statements of HALE at the acquisition has disclosed a contingent liability. So the subsidiary company has disclosed a contingent liability which will be recognized by the group as a provision for contingent liability. What is the provision? What is the fair value of this contingent liability? 2 million. 2 million. Okay, so we will have to recognize this. We will have to recognize this. Okay, so now let's write about contingent liability. Let's write about contingent liability. So what will we write about contingent liability? Okay, so we'll write contingent liability of subsidiary will be recognized in group FS at its fair value on date of acquisition if it is a present obligation and its fair value can be determined. Okay, so we have to recognize that. Okay, so now what will happen? What is the fair value on date of acquisition? What is the fair value on date of acquisition? So tell me please, what is the fair value? 2 million. 2 million. Now tell me, what is the effect of this contingent liability on goodwill? What is the effect of this contingent liability in goodwill? So basically this will reduce net assets. This will reduce net assets because it's a liability. Liability is increasing, net assets will reduce, and ultimately and hence it will increase goodwill. It will increase goodwill. Okay, so we have written fair number of points. We have written fair number of points, right? We have written about goodwill. We have written about deferred consideration. We have written about contingent consideration. We have shown the calculation. We have written about the contingent liability. Okay. Now one more point which you can write about goodwill is goodwill calculated on date of acquisition does not change subsequently. Because the question is asking us to write the financial reporting principles underlie the accounting of goodwill. So goodwill calculated on date of acquisition does not change subsequently. It is not amortized. However, the same needs to be tested for impairment annually. Okay, at the same time every year. So now the question was of 5 marks. We have written how many marks? See, 1 mark, 1 mark, 1 mark, 1 mark, 1 mark, right? And 1 mark. See how many points we have written? Tell me. We have done 6 number of points. You can, if you want, you can eliminate this one. If you want, you can eliminate this one, right? If you want, you can eliminate this one. Okay, but yes, this is how you have to write. Now tell me, is it something very difficult? Is it something very difficult? Come on guys, tell me please. Is it something very difficult? Come on guys, please tell me. Okay, chalo. Done. So this is question number 1. I believe you have got the confidence. But now, though the question is not asking, but can we please compute goodwill? Can we please compute goodwill? Though the question is not asking you to compute, but can we please? Okay, cash consideration is how much? 50 million. Present value of deferred consideration is how much? See, we are not studying here just to solve these questions. We are studying here so that if any question comes up in the exam from the chapter of group accounting, we should make sure that we are scoring 30 out of 30 in the exam. That is my intent. That should be our intent. Tell me, are we on the same page in this? Are we on the same page in this one? Okay, now what is the present value of deferred consideration? It is 20 million. What is the fair value of contingent consideration? It is 40 million. So this is the value of your investments. Now what is the fair value of NCI on date of acquisition? I believe it was given in the question. Non-controlling interest has a fair value of 30 million. Now what is the net assets? So net assets, let us find the net assets now. Net assets. So question says that ordinary share capital is 80 million and retained earnings is 50 million. Share capital is 80, retained earning is 50. So this is the carrying amount of net assets plus a fair value adjustment on account of contingent liability minus 2. So 80 plus 50, 130 minus 2 is 128 is other net assets. Okay, so what is your goodwill? What is your goodwill? So goodwill is 12. Goodwill on the date of acquisition is 12. Goodwill on date of acquisition is 12. Is that clear, everyone? Come on, guys, please tell me. Can we move on to question number 2? Can we move on to question number 2? Chalo. Moving on to question number 2. Now, again, in question number 2, tell me, will we be reading this scenario first? No, 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 no. So first of all, we have to read the requirement of the question. Calculate goodwill. So first part is calculate goodwill and explain how the fair values of the consideration of the net assets have been determined. Explain how the fair value of the consideration and the net assets has been determined. Okay, so understand, whenever a question comes up, calculate and explain. So in my understanding, you should first calculate. You should first calculate, because when you calculate, it gives you a fair understanding about each and everything, and it becomes very much easy to explain things. Okay, it becomes very much easy to explain things in that case. Sorry. Chalo, let us read the question and start solving for the calculation of goodwill part. Okay, now Columbia is a parent of the listed group which operates within the telecommunications industry. During the year ended 31st December 2005, Columbia has acquired a new subsidiary and made adjustments to its pension scheme. The group's current year end is 31st December 2005. Okay, acquisition of Peru. Brazil is a competitor of Columbia Company on 1st July 2005. Both Brazil and Columbia acquired 50%. So let me write this data. It will be helpful. It will be helpful. So let me write this data. Okay, on 1st July 2005. Okay, Brazil acquired 50% of Peru, and on the same date, even Columbia Company acquired 50% of Peru. Both the company acquired 50%? Yes, both the company acquired 50%. Now the consideration transferred by Columbia, consisted of cash of 8 per share and also a 1 for 20 share exchange. Okay, now then Brazil also paid 8 per share for their interest but did not issue any shares. Following the acquisition, Colombia has the contractual right to appoint 60% of the board of Peru, and remaining 40% will be appointed by Brazil. So now even though by virtue of voting rights, each of these company, Brazil and Colombia, has 50% of Peru, but who has the ultimate control? Come on guys, tell me, who has the ultimate control, Colombia or Brazil? Who has the ultimate control of Peru, Brazil or Colombia? It is the Colombia Company. Why? Because Colombia Company, by way of contractual arrangements, has a 60% controlling power, 60% right to appoint the board, right? So it has the majority power. So Colombia Company is the parent company. Colombia Company is the parent company. Okay. So now, but are we required to conclude on that part in this question? No. Is the requirement asking me to discuss that? No. The requirement is asking me to compute goodwill. Now, goodwill will be computed from the point of view of which company? Columbia Company, because Columbia is the parent company. Columbia is the parent company. Okay, now let us read the second exhibit now. The net assets of Peru reported in the individual financial statements. Okay, now first of all, we need to find goodwill. For that goodwill, we need investments. So investment is of two types: cash consideration and fair value of share exchange. Fair value of share exchange. So now tell me, what is the cash consideration? Okay, for that we need how many shares that we have acquired. How many shares we have acquired? So Peru company had, if you can see in the question, Peru company in total had 5 million shares of Peru. Both Brazil and Colombia acquired 50%. Okay, so I'm talking from the point of view of Colombia. So Colombia would have acquired 50% of 5 million. 5 million, okay, multiplied 50%. This is the number of shares acquired. Okay, now what is the number of shares issued by Colombia? 1:20 share exchange ratio. Now this is the number of shares issued by Colombia company. Now what is the value? So we need to multiply it with the fair value per share of the Colombia company. Okay, so now market price of Colombia is 10 per share, so multiplied by 10. This is the fair value of share exchange. 1.25. What is the cash paid? Cash consideration. So cash consideration says cash of 8 per share acquired. So this is the number of shares multiplied by 8. So this is the investment, value of investment. This is the value of your investment. 21.25 is the value of your investments. Now let's move further into the question and read that part. Okay, guys, I believe you are aware that when we are consolidating a subsidiary, the accounting policies should be made same if they are not same, right? I believe you are aware of this part. Okay, now let's read the question. I will take a different color pen now, green. The net assets of Peru reported in the individual financial statements had a carrying amount of 32 million. Okay, so net assets had a carrying amount of 32 million. So let me write that here. Net assets, carrying amount of net assets of Peru is 32 million. What's next? However, on acquisition of Peru, the directors of Colombia company discovered the following. So let us discuss each of these one by one. So basically there is issue number 1, issue number 2 and issue number 3 pertaining to the net assets. There are 3 issues. So now we have to discuss each of these issues one by one. Okay, so let us discuss that. On 1st January 20x5, that is prior to date of acquisition, Peru company acquired 6 million. The subsidiary company acquired 6 million 6% coupon bonds for $6 million. In an unquoted company at par, bond interest is paid annually. The contractual cash flows are paid annually. Now, due to a premium on redemption of these bonds, the effective interest rate, of these financial assets was 8%. Peru company has a business model to collect the contractual cash flows of the bond and therefore measure them at amortized cost. So can you please tell me what should be the carrying amount of these bonds? Note 1. I'm writing here note 1. Bonds. So now tell me, what is the carrying amount on date of acquisition, that is 1st July 20x5? What is the carrying amount of these bonds? So tell me, we purchased the bonds at 6 million. Okay, now plus we will have to charge the finance income on these bonds, right? We have to charge the finance income on these bonds. Now, how to calculate finance income? So 6 multiplied by effective interest rate is 8%, multiplied by, we have to take from 1st January 2005 till 1st of July 2005, means Jan, Feb, March, April, May, June. 6 months into 6 by 12. So this is the carrying amount. Tell me yes or no. This is the carrying amount. Tell me yes or no. 6.24. 6.24 is the carrying amount. But now tell me what we know. We have to record all the assets and liabilities of subsidiary at its fair value on date of acquisition. So now we need to find what is the fair value on 1st July 20x5. What is the fair value of these bonds on 1st July 20x5? So now how to compute fair value? Now fair value will be computed from the point of view of parent. So let's read the question further. Columbia, the parent, holds similar unquoted assets but has a business model whereby they may collect contractual cash flows or sell the asset, that is FBT OCI. Bonds with a similar risk profile for similar quoted company were being traded at a 2 per bond, but this fair value of 2 per bond is for a quoted company. Quoted company means listed company. Ours is an unlisted company. Ours is an unlisted company, right? So for that, it says a discounting of 30% is considered for liquidity, means since it is not a listed company, the investment that we have done is not in the listed company, we will discount this fair value of 2 for 30%. Okay. So now, so what is the fair value? We have invested 6, right? Now we have invested 6 million bonds at a fair value of 2. At a fair value of 2 multiplied by, we have to take the value, sorry, 6 into 2 is the fair value, but we have to take 70% value because 30% discounting, right? So what is the value? What is the value now? 8.4 is the fair value. 8.4 is the fair value. So what is the fair value adjustment on date of acquisition pertaining to the bond? It is this minus this, 2.16. 2.16. So what is the fair value of net assets? We'll compute later on. Now moving on to the second point. Guys, are you understanding? You understood this point? You understood this point? Come on, please tell me. You understood this bonds wala point? Everyone, come on guys, please tell me. You understood the bonds wala point? Moving on to note number 2. Okay, this is for brand. This is for brand. Now the question says, one of the identifiable Khushi is asking, how did you compute fair value? So understand, this is the number of bonds that I had, that the subsidiary had. This is the fair value per bond that is given. But this $2 is the fair value per bond of a listed company. But we have done investment in a unlisted company. So for that, we have discounted it by 30%. We have discounted it by 30%. So basically what we are saying here is we have done an investment of 6 million bonds, and the fair value of the bond is this much. 2 into 70% is the fair value of the bond. If we would have done the investment in the bonds of a listed company, the fair value would have been 2. But since we have done in the investment in the unlisted company, the fair value is 2 into 70%. It is 1.4. 1.4. Okay. Now we multiply, we get the fair value. This is a fair value adjustment on date of acquisition. Okay. Now coming to the second point, that is brand. One of the identifiable intangible assets of Peru at acquisition was a brand. The brand had a carrying amount of 4 million on 1st July 2005. So what is the carrying amount on 1st July 2005? It is 4 million, right? It is 4 million. It is 4 million. Now what else? Columbia company has a similar branded product and is therefore planning to discontinue the trade of Peru's branded product. So basically the parent company is saying subsidiary's brand name has a carrying amount of 4 million. Okay, but we don't need subsidiaries brand name because we have our own brand name. It's like Zomato acquiring Swiggy. It's like Zomato acquiring Swiggy. It's like Zomato acquiring Swiggy. Now tell me, does Zomato need the brand name of Swiggy? No, no. Zomato doesn't need the brand name of Swiggy, right? So it says that we don't need the brand name of Swiggy, okay? So, but we can sell the brand name for 5 million. We can sell the brand name for 5 million. So what is the fair value on 1st July 20x5? Fair value is 5 million. So what is the fair value adjustment? It is 1 million. Tell me, is it clear? Should we explain these adjustments? Yes, we have to explain. See, now tell me, this is how we have to explain. See what I'm doing here. I'm explaining these adjustments. I'm explaining these adjustments one by one. See, the question is asking, no, question asks us, right? Explain how the fair values of the consideration and the net assets are to be determined. So we are discussing that. See, I'm explaining you what is the adjustment that has to be done for the bonds, what is the adjustment that has to be done for the brand. Okay, just that you have to explain this in words also, which I will be also doing with you guys. Don't worry at all from this picture. I'll be explaining each and everything. Okay, don't worry at all. So this is the fair value of brand. Now coming to note number 3. Now note number 3 is from the point of view of service contracts. Peru company has several technical support service contract for which there are outstanding performance obligation at 1st July 2005. Included in the contract liability deferred income at that date is a balance of 2.8 million. So it says carrying amount of deferred income. Carrying amount of deferred income is how much? 2.8 million. Is 2.8 million. Now, what is the fair value of these deferred income? It is estimated that these contracts will cost 1.7 million for Peru and they will earn a markup of 30%. So what is the fair value? So fair value, cost is 1.7, markup is 30% of 1.7. Okay, so what is this? 1.7 into 1.3. Okay, so this is the fair value of the deferred income. So what is the fair value adjustment? This minus this, 0.59. Your liability should decrease. So this is the fair value adjustment. Okay, fair value adjustment. Tell me, is that clear, everyone? Now I believe we can fairly compute goodwill. Goodwill now. Okay, how to compute goodwill? Let's compute goodwill. Computation of goodwill. So goodwill will be investment figure is how much? 21.25. Now what is the value of NCI on date of acquisition? So now tell me, if Columbia company acquired 50% of Peru and became a parent, then who is the NCI? Sorry, Columbia company acquired 50% of Peru and became a parent, then who is the NCI? Brazil company is the NCI. Brazil company is the NCI. Now what is the fair value of NCI? What is the fair value of NCI? Okay, so let us compute the fair value of NCI. NCI had 5 into 50% shares. Okay, 5 into 50% and at a value of 8. is 20. 20 पक्का? ठीक है. So this is the value of your NCI. What's next? Less net assets will be how much? So net assets carrying amount was 32. Bonds increased in value 2.16, so will increase. Plus brand name also increased in fair value, so will add up. Now liability is decreasing. Liability is decreasing, so net assets will increase 0.59. Net assets will increase. Tell me what is the value of the net assets. Come on guys, tell me what is the value of the net assets. What is the value of the net assets? So it will be 32 plus 2.16 plus 1 plus 0.59. It is 35.75. So what is the value of your goodwill? It is equals to this plus this minus this. 5.5 is the value of your goodwill on date of acquisition. So now, what is the requirement? Let's come to the requirement again. Calculate goodwill on 1st July 2005. So for this part, draw pencil. So for this part, calculate goodwill. Okay, you will get 3 marks. Okay, now for explain how the fair values are computed. Okay, you will get 5 marks. You will get 5 marks. What is the total marking scheme? 8 marks, right? So for this one, you will get 5 marks. So for this 5 marks, you have to comment for 5 points. For this 5 marks, you have to comment for 5 points. Now tell me, how can you comment? How can you comment? You can comment on bonds, 2 marks. So this one will have 2 marks. Bonds. Brand will have 1 mark. Okay. Service contract will have again 2 marks. Okay. So 2 plus 1 plus 2, 5 marks. 2 plus 1 plus 2 is 5 marks. Okay. So this is how we compute. Okay. Or you can say you give us the 1 mark, and this fair value of share exchange will also have 1 mark. Yes, this is better. Bonds, we have to do calculation, 2 calculations. Brand, we have to do 1. This one 1. Yes, it will be 1 mark. Service contract 1 mark, brand 1 mark, bonds 2 mark, and fair value of share exchange 1 mark. So totaling to 5 marks. Now, Khushi is asking me a query. Sir, in the books of Columbia Company, okay, Peru is subsidiary. Yes. Brazil is NCI. Yes, I agree. Now, what will happen? What will happen in case of in the books of Brazil company? In the books of Brazil company, Peru will be an associate. Peri will be an associate. Okay. Okay. Chalo. Now one student asked me, sir, this liability fair value adjustment will be deduct? No. If the value of liability increases, we reduce net assets by deducting it here. But here the value of the liability is decreasing. Liability decreasing, net assets increasing. So that's why we have added it here. Okay, that's why we have added this 0.59 here. Is that clear, everyone? Is that clear, everyone? So this is how we discuss question number 2 as well. Tell me, guys, are you getting confidence now? Are you getting confidence? Is this clear, everyone? Come on, guys, please tell me. Is it clear, everyone? Is it clear, everyone? Chalo. Moving on to question number 3. This question is not from your book. This question I have taken from CA final book. I have just one point that I want to discuss with you from this question. Okay, just one point that I want to discuss with you guys from this question. Okay, let us discuss the question. What is the requirement? Requirement is saying compute the goodwill. Guys, Tell me first of all. Now, given that we have discussed two questions already, tell me, are you getting the required confidence? Come on, guys, please tell me. Are you getting the confidence now? Are you understanding things? Are you feeling better now? So what happens? Please understand. See, these what we are doing is the intent behind this session. The intent behind this session is I am discussing the concept based questions of the group accounting, focusing on each and every pain areas of the group accounting so that you understand the application of the knowledge of the group accounting. Okay, followed by this. Okay, in my SBR crash course, I will be discussing full length questions also. I will be discussing full length questions also, exam level. Okay, I'll show it to you which questions I'll be discussing. Just a minute, so that you understand what is the intent. I'll show it to you. See, these are the full-fledged questions, okay? One from the group SOFP, then group P&L, right? Everything, group SOFP, group P&L, group cash flows, foreign subsidiary, right? And also, apart from these, I have also few more questions also, okay? In addition to this, I've added few more questions. But this I will be discussing, this part I will be discussing in the crash course, not here, okay? This part I'll be discussing in the crash course, not here. Just a minute, again I'm coming to that part. Okay, so the intent behind this session is to help all the students, whether they have enrolled with me or not, help all the students in understanding how to apply the knowledge of the group accounting in the given case scenario. Okay, so what I have done is I have identified that pain areas and I have taken each and every question on that. Okay, if I was able to find the question from your kit, from your study hub, from your past papers, well and good. If not, I have brought these questions from other materials as well. Okay, just to show you, if you can see here, see this question is from your past paper. Okay, this question again, past paper, SBR past paper. Now next question, if you can come and see, this question is from CA final book. Okay, CA final. So intent is to help you understand how to apply the concept in the given case scenario. And I believe we are able to achieve that. Okay, chalo, let us move on to question number 3. In the question number 3, the requirement says, compute the goodwill on consolidation of Bosman Limited. Okay, and also state the treatment of contingent consideration at 31st March 20x2. So these are the two requirements of the question. Let us first of all focus on the computation of goodwill. Let us read the question one by one. Johansson acquired on 1st April 20x1, that is the date of acquisition. Johansson acquired a new subsidiary, Bosman, purchasing all 100% shares, purchasing all the shares, 150 million shares of Bosman. The terms of the sale agreement included the exchange of 4 shares in Johansson for every 3 shares acquired in Bosman. The market value. So now tell me, what is the fair value of share exchange? What is the fair value of share exchange? This is, we have acquired 150 million shares. Okay, now for this, how many shares are we issuing? We are issuing 4 shares for every 3 shares acquired. It's 4 by 3. This is the number of shares that we are issuing. Now, what is the fair value of our shares, that is Johansson shares? It is 10. So multiply by 10. So this is the fair value of share exchange 2000. Okay. Now, further, the terms of the share purchase included the issue of one additional share in Johansson for every 5 shares acquired. Again, a fair value of share exchange. Let's see. If the profits of Bossman for the 2 years exceeded a target figure. Now, we are issuing equity shares after how many years? 2 years. After 2 years. If the specified condition is attached. If the specified condition is attached is, you can say attained, achieved, right? Then in that case, we will be issuing equity shares of my own company. Now tell me the number of, okay, it is a contingent consideration. Hence, we have to measure at fair value on date of acquisition. But please remember, as part of contingent consideration, we are promising to issue the equity shares of my own company. Fixed number of equity shares of my own company. So it is a contingent consideration in the form of equity, which we will measure at fair value on date of acquisition. But will we remeasure it at each reporting date? Will we remeasure it at each reporting date? No, we are not going to remeasure it. No, we are not going to remeasure it. So let me write that part here. Fair value of contingent consideration. Fair value of contingent consideration. And what is the fair value? What is the fair value? We have acquired 150 million shares multiplied by, we have to issue 1 share for every 5 share acquired, and the fair value is 10. Fair value is 10. So this is the contingent fair value of the contingent consideration on date of acquisition. Now, if you can remember, question has asked us to suggest the treatment of contingent consideration. So let me write it now itself. Treatment of contingent consideration. Treatment of contingent consideration. So we will write here, okay, Johansson company, Johansson will issue how many shares? 150 by 5 is 30 million equity shares of its own entity at the end of second year, if the specified condition is achieved. If the specified condition is achieved. Okay. Now, since the number of shares to be issued is fixed, hence it is an equity instrument. Okay, it should be measured at fair value on date of acquisition equals to how much? What is the fair value on date of acquisition? Tell me, guys, please. What is the fair value on date of acquisition? 300. Okay. Further, any changes in fair value will not be accounted as why as equity is not remeasured. As equity is not remeasured. So this is what you have to write about the contingent consideration. Tell me, guys, is it clear now? Is it clear now, all of you? Come on, guys, please tell me. Sir, but how are these equity shares fixed when they depend on a target to be achieved? Okay. See, understand two things. See, please, two things. The issue of the equity shares is dependent on the condition. But if we have to issue the equity shares, is the number fixed? Is the number fixed? If we have to issue, if the condition is achieved, tell me, okay, think of it like this. Think of it like this. If condition achieved, if condition achieved, we'll issue 30 million. If condition not achieved, we will issue 0 million. We'll issue 0 million, right? Now, because there is a condition, it makes this consideration contingent consideration. Okay, but if we have to issue, we will issue 30 million. So the number of shares is fixed. So the number of shares is fixed. Okay, the number of shares is fixed. The number of shares is fixed. Now think of it like this. If the question would have said, the Johansson company will issue sufficient number of equity shares. Okay, if the specified condition is achieved, meaning thereby, as of today, we don't know that if the condition will be achieved, how many equity shares we will be issuing. We don't know that. Then the number of shares is variable. Okay, then in that case it will be a contingent consideration in the nature of financial liability, and yes, in that case we will be remeasuring it, and the remeasurement gain or loss will go to P&L. Is that clear? Everyone? What about 80% probability? Rajni is asking, what about 80% probability? So 80% probability means it makes us more likely than not probable that we have to record this contingent consideration. We will be issuing equity shares. Okay, it makes it certain that, quite certain that yes, we will be issuing equity shares. It is probable that we'll be issuing equity shares. Okay. Let's suppose if the estimate would have said 30% probable, then might be the case that we would have not recorded this contingent consideration in that case. Okay, in that case we would have not recorded it. Okay, 80% makes it probable that it will be paid. It will be the equity shares will be issued. Okay, and if it will be issued, we will be issuing how many shares? 30 million shares. Okay, now next part, transaction costs. This part, I have seen students struggling here. I have seen a lot of students struggling in this acquisition related cost. So let me, though the question is not asking us, but still let me discuss acquisition related costs. So ideally the acquisition related cost, that is a legal cost, issue cost, all those things goes to P&L. But if the acquisition cost is in nature of cost of issue of equity shares, will it go to P&L? No, it will be adjusted. Okay, then in that case, will it go to P&L? No. Will it be forming part of investment? No. Then what? It will be adjusted with either retained earnings or share premium, whatever is the balance given. Okay, these two, no, strike through. So as part of this question, these two things were the point which I ideally wanted to discuss with you. The intent to take this question was these 2 points. Is it clear, everyone? Come on, guys, please tell me. So this is the value of your investment. Now, what is the value of your net assets? The individual balance sheet. The individual balance sheet of Bossman comprised net assets had a fair value of 1200 million. Net assets had a fair value of 1200 million. Okay, now Purnima. So the query of Purnima is probability decreased to 30%. The fair value will decrease. But since it is in the nature of equity, will we remeasure it? No, we will not remeasure it. So now it doesn't make sense whether the fair value increases, decreases, probability increases, decreases. It doesn't make sense. Okay. Net assets is 1200 million. Now, customer relationships. There are certain other assets also. Okay. Additionally, Johansson had certain other assets. Johansson considered that the Bosman, that is subsidiary, possessed certain intangible assets that were not recognized in the individual SOFP. And what are they? They are customer relationships. Customer relationships. Will we recognize? Yes, we will recognize it at its fair value on date of acquisition, that is 100 million. In process research cost, will we recognize? Yes, we will recognize it at its fair value, that is 50 million. Employee expertise. Can we recognize employee expertise? Come on, guys, please tell me. Can we recognize employee expertise? No, we can't. No, we can't recognize employee expertise. No, we can't recognize employee expertise because employee is something not in our control. So we cannot recognize that as an asset. We cannot recognize that as an asset, okay? Because this is not in control. Not in control. Okay, now, so we have to recognize these two. So let us recognize, it will be, sorry, bad. Fair value of customer relationship is 100 plus in process research is 50. So what is the value of the net assets? 1350 is equals to minus 31350. Now tell me, guys, do we have any NCI? No. Why? Because we purchased all the shares. We purchased all the shares. We don't have any NCI. We don't have any NCI, right? So what is the goodwill? Goodwill is this plus this. Is your goodwill 950? Sorry. Is your goodwill 950? Is that clear, everyone? Is that clear, everyone? Chalo. So this is question number 3. Moving on to question number 4. So far we have discussed 3 questions. Tell me, how are you feeling now? Are you feeling confident? Are you feeling confident? Come on, guys, tell me. Come on, guys, tell me. Okay, chalo. Let us discuss this question. Question number 4. Sterling Company is currently preparing its individual and consolidated financial statements. Okay, what is the requirement? Explain how birthholds will be accounted for, including calculations in the Sterling consolidated financial statements. Okay, console P and L. How will you? And explain and show how the goodwill in birthhold will be calculated. Okay, so let us discuss this part as well. Now, we have to answer 2 questions. We have to answer 2 questions. Now understand. Part 1 is saying how birthhold will be accounted for. Means how will Sterling account for birthhold for FY ended 31 March X9 in console PL. This is the requirement. How will? Right? Is the requirement clear to all of you guys? Come on, please tell me. Is the requirement clear to all of you? For the year ended 31st March 2009, how will Sterling Company account for birthhold? How will Sterling Company account for birthhold? Okay, for the year ended 31st March 2009. Chalo. Let us read the requirement. We'll go one by one. Don't worry at all. Don't worry at all. I am there. I will be helping you in each and every stages. Don't worry at all, guys, all of you. Okay. Chalo. What is the question saying? Sterling Company is currently preparing individual and the console financial statements for the year ended 31st March 2009. Now we need to make a note that we need to suggest accounting treatment in console P&L. Okay, for 31st March X9 about birth hold. Important things. Okay, now we have to think from that perspective. Let's read the scenario now. Sterling Company paid 25 million for 40% birth hold 10 million ordinary shares on 1st January 2007. Oh, we acquired 40%. 40% we acquired on 1st January 2007. Okay. The retained earnings on that date were 18 million. Okay. Berthold had no other reserves. Okay. If nothing is given, what will we assume this? What will we assume? 40% holding, significant influence, associate. Now question. Sterling Company exercised significant influence. Oh, the question is given also. It is a significant influence, meaning thereby Berthold will be accounted for as an associate. Now, a further 35% stake in Berthold was acquired on 1st December 2008. Now, understand. Please understand, guys. Question is asking for the financial year ended 31 March 20x9. Then tell me, please, can I say it like this? Can I say it 31st March x9 means 1st April x8 to 31 March x9, right? Now, from 1st April 20x8 till 1st December 20x8, it was an associate. Right? Now, further, on 1st December 20x8, it is a date of acquisition, and from 1st December 20x8 till 31 March 20x9. So this is your subsidiary. Right? Now tell me, how do we account for, if it is subsidiary, if it's an associate, we write one single line item, a share of profit of associate. On date of acquisition, we see what is the value as per equity method, what is the fair value, the gain or loss will go to P&L. Now, from 1st December 2008 till 31st March 2009, we will do line by line consolidation because it became subsidiary. Tell me, guys, is that clear to all of you or not? Come on, guys, please tell me. I don't think it is that difficult, yaar. It is quite very easy in my opinion. So let us solve it, okay? So profit for the year of Berthold is 11 million. Profit for the year is 11 million. Okay, so now understand, in this period, since Sterling exercised significant influence over Berthold, hence an associate. Are we required to prove significant influence? No, it is given in the question. Okay, since it is an associate, we follow equity method. Simple. We follow equity method. Is that clear, everyone? Now, in P&L under equity method, in consol P&L under equity method, we present a single line item as share of profit of associate. Share of profit of associate. Simple. Now what is the share? Therefore, or share of profit of associate is equals to 11.1 multiplied by how many months? April, May, June, July, August, September, October, November. 3 plus 3, 6, 6 plus 2, 8 into 8 by 12 multiplied by what is the percentage holding? 40%. Okay, so what is the amount? $2.96. Tell me, is that clear, everyone? Is that clear, everyone? Come on, guys, please tell me. Now, on 1st December 20x8, on 1st December 20x8, what happens? Sterling acquired a further stake of 35%, totaling to 40 plus 35, 75%, which is a controlling stake, controlling interest. Okay, now hence it is a subsidiary now. Hence it is a subsidiary now. Okay, hence Sterling will need to remeasure previously acquired interest of 40% at its fair value Okay, now so first of all, let us find out what is the carrying amount of 40% as per equity method. Okay, chalo. So what is the carrying amount of 40% at equity method? So what is the cost? Tell me. What is the cost? Cost is 25 million. Cost is 25 million. Then further, what is the retained earning on date of this one? When we acquired that associate, 18 million. There are no other reserves. And what is the retained earning on the date of acquisition? Is it given in the question? Kya? Is it given in the question? Yes. Berthold's retained earning is 42.3 million on this date. Okay, so we can say share of profit is 42.3 retained earning on the date of acquisition 1st December 2008 minus retained earning of 18 million when the associate were originally acquired, multiplied by 40%. Okay, what else? I don't think so anything else. So it is what is the amount? 42.3 minus 18 into 0.4 is 9.72 plus 25 is 34.72 is the amount. 34.72 is the amount. Okay, now what is the fair value of this 40%? What is the fair value? What is the fair value? The market price of Berthold shares just prior to 1st December 2008 was 9.2. Okay, so fair value will be equals to total Berthold shares is 10. 40% is 40% multiplied by 9.2. $36.8. So what is the fair value gain? So it is 36.8 is a fair value, carrying what is much. So 2.08, where will be recognized? So right here, this gain will be recognized. This again will be recognized in console P and L, investing activity. Okay. Investing activity. Because question is particularly asking about console P&L treatment, right? So we have to highlight investing activity or operating activity. So these are investing activity. But now from 1st December 20x8 till 31st March 20x9, won't we apportion the retained earning profit for 8 months? Why? Khushi, this is the value as on this date, right? The cost on the date of 1st January 20x7. This is on 1st January 20x7. We need to find the value, carrying value on 1st December 20x8. So we need to find from 1st January 20x7 till 1st December 20x8. Getting my point, Khushi? Getting my point, Khushi? Okay. If it comes about what is that we have to record in P&L. See, we have done the time apportionment, but we are finding the carrying amount. We are finding the carrying amount. For carrying amount, we don't do time apportionment. For carrying amount, we don't do time apportionment. Okay. Carrying amount is an SOFP figure. SOFP, we don't do time apportionment. Now, from 1st December till 31st March 2009, since Berthold is a subsidiary now, it will be accounted for on a line by line consolidation. Since it is acquired in mid of the year, okay, acquired during the year, not mid, during the year, Sterling will need to time apportion Berthold for how many months? December, Jan, Feb, March, for 4 months. For 4 months. Okay. Now, the profit for these 4 months will then be allocated to parent and NCI in the ratio of their shareholding. See, I have written a lot of the points, but we need to be mindful. What is the marks? 14 marks, 8 marks for this one. So for these, you have to write for 8 marks. So how many marks have written so far? See, 1 point, 2 point, right? 3 point, 4 point, this calculation, 2.6 point, then 7 point, 8 point. We have written as good as 8 points for 8 marks. We've written as good as 8 points for 8 marks. Tell me, is that clear? Now, and tell me, the way in which I'm writing, don't you think it is something very much achievable for you to write as well? Like the way it is written in the answers in the book, they are very lengthy. But the one I am writing, don't you think it is quite very achievable? Don't you think it is quite very much achievable answers? You can definitely write these answers. Tell me, guys, come on. These are the answers which you can definitely write it easily on your own also. Very simple language. And I can assure you, if you write these answers, you will get full marks. No one can deduct even a single marks. Okay. Moving on to question number 2. If you want, you can show that also, because the profit is given. So post acquisition profit is equals to 11.1 into 4 by 12 is equals to how much? 11.1 into 4 by 12 is 3.7. Now allocated to parent and allocated to NCI. Okay, how much? 3 equals to 3.7 multiplied by how much percentage we have acquired? Tell me, guys. 40 plus 75%. 75%. Okay, into 75% and 3 into 25%. Is it clear, everyone? Is it clear, everyone? Come on, guys, please tell me. Is that clear, everyone? Is that clear, everyone? So question number 4 is also done. Question number 5. Question number 5. Okay. Now, there are a few small questions also, don't worry, we will be completing, okay? And I assure you that I will be completing these 24 questions with you, and then only I will wrap up this session. But be with me, you have to be motivated enough. Please watch this session till the end. I am giving you a guarantee that you will get the confidence in the group accounting chapter, because I have got that strong level of questions. Part 2 of question number 4. Did I miss that? Thanks, Purnima. Thanks, Purnima. I am so sorry. I'm so sorry. I missed that. That's what happens in the exam. That's what happens in the exam. We miss reading the question itself. Okay. So let us solve the second part. Solve the second part. Calculation of goodwill. Calculation of goodwill. What is the amount? Sterling company is currently preparing its financial statements. Okay, ठीक है, चलो. Now, what is the cost of 35%, fair value of previous 40%, fair value of NCI on date of acquisition, less what is the net assets? Okay, chalo. Cost of 35% is 41 million. Fair value of 40% is 36.8 million. Net assets on date of acquisition is how much? Please tell me. Okay, when the fair value of the net assets was 55.3. Okay, 55.3. Net assets is 55.3. What is NCI? What is the question saying about NCI? Measures NCI at fair value on the date of acquisition. Okay, fair value of the date of acquisition. Okay, so now what is the percentage of shares held by NCI? What is the percentage of shares held by NCI? 25%. Total number of shares is 10 million. So 10 into 25% multiply. What is the fair value per share? So it is given the market price of the Berthold shares was 9.2. So into 9.2. 23 is 45.5 is the value of goodwill on date of acquisition. Is that clear? Now you have to explain this also. So how will you explain? This is fine. So this part you will explain that previously acquired interest has to measure at its fair value. NCI, how did you compute the fair value of NCI? Net assets, how did you compute the fair value of net assets? You have to explain that part. Okay. So 3 marks for the calculation, 3 marks for the explanation, 1 marks for the explanation of this one, 1 marks for the explanation of this one, and 1 marks for the explanation of this one. So this is how you have to solve it. Is that clear, everyone? Is that clear, everyone? Come on, guys, please tell me. Moving on to question number 5. Moving on to question number 5. What does the question say? Explain with calculations how the goodwill on acquisition of layout will be determined in the console FS of the Greer Group ended 31st December 20x7. 31st December 20x7. Okay, chalo. Let's solve this question. Quite an easy, simple question. Quite an easy and a simple question. Greer Company is a listed company in the manufacturing group. Okay. Now, Greer Company, whose shares are listed on stock exchange, and Layout Company, an unlisted company, entered into a business combination in 2 stages. On 1st January 2007, Greer Company purchased 35% equity share capital and the rights of Layout for cash. On 1st April 2007, Greer Company acquired the remaining 65% equity share capital by issuing new shares to the Layout Company's shareholders. Step acquisition case. Okay. Now, so how will we calculate goodwill? First of all, let us calculate goodwill and then we'll explain that part also. Okay. Chalo. Now, 35%. First of all, we have acquired 35%. So for this, we need the fair value. Okay. What is the date of acquisition? Come on, guys, tell me. What is the date of acquisition? First of all, tell me the date of acquisition. The date of acquisition. On 1st January 20x7, we acquired 35%. On 1st April 20x7, we acquired the remaining 65%. So the date of acquisition is 1st April 2007. Okay. Now, so what is the cost of 65% stake that we acquired? Okay. Greer Company issued 25 million shares of its own company. Okay. So 25 into what is the fair value per share? 22.85. This is the cost of investments. This is the cost of investments. Copy. Okay. Now, further, what is the fair value of the previously acquired interest? Fair value of the previous 35%. Paid 34 million, that was the cost, but we need the value today. We need the value today. Okay, Greer Company had 35% holding as an associate. Its carrying amount is 36 million. The fair value of the identifiable assets is 87 million. Tell me, guys, come on. What is the fair value of the previously acquired interest? Come on, tell me. So what is the fair value? See, Greer Company had a market value of 17 million. Layout Company had a market value of 90 million. Okay, so we need 35%. So 90 into 35%, simple. 31.5. This is the value of the previously acquired interest. What was the carrying amount? What was the carrying amount? 36 million. What is the fair value? 31.5. Difference is how much? 36 minus 31.5. 36 minus 31.5. Difference is 4.5. Where will this 4.5 go? P and L. Where will this 4.5 go? P and L. It's a loss. Remeasurement loss. Okay, so with this we acquire the entire 100%. Will there be any NCI? Nah. Will there be any NCI? Nah. So less net assets. Less net assets. So what is the net assets? Come on, guys, please tell me. What is the net assets? Net assets is 87 minus 87. So what is the goodwill? 15.75 is your goodwill. On date of acquisition, is it impaired anything? No. On what date we need? On what date do we need? 31st December 2007. So from 1st April 2007 till 31st December 2007, is it impaired? No. For how many marks we need to solve this question? We need to solve this question for 5 marks. So 3 marks is for this calculation. 3 marks is for this calculation. Now 2 marks will be for explanation. How? So first of all, you have to write it is a case of step acquisition. It is a case of step acquisition. Okay, and you have to measure fair value of the previously acquired interest. Okay, and any gain or loss, will go to P and L. Then you have to also say how did you compute fair value of NCI. Okay, so now 3 marks for this computation and 2 marks for this explanation, 1 and 1. So you have to explain how did you compute fair value of NCI, that is value of the layout company was 90 million, we had 35%, so we took the value, proportionate value, we took it off. Okay, step acquisition, you have to write this point, and these 1 and 1, 2 marks, 2 plus 3, 5 marks. Tell me, is that clear, everyone? Is that clear, everyone? Come on guys, please tell me, is that clear, everyone? Question number 6. Come on guys, I need a confirmation from each one of you now. I need a confirmation from each one of you. Is that clear to everyone till here? Is that clear to everyone till here? Perfect. Okay, now we are moving on to a question of replacement awards. I'm writing here, it's a question of replacement awards, and I have seen students making a mistake in this question. Now first of all, understand what is the meaning of replacement awards. Okay, what is the meaning? Let's suppose parent acquired subsidiary. Okay, now so please understand, subsidiary company would have issued share based payments to its employees. Okay, now but when parent acquires subsidiary, parent says that whatever share based payments you have issued to your employees, let's cancel that off, and on the behalf of subsidiary, parent will now issue the shares of parent to the employees of subsidiary. Okay, so now what is the treatment of replacement award? Add fair value of pre-combination award, add fair value of pre-combination award to investments. It will increase the value of investments. It will increase the value of your investments. Okay, what is the journal entry to account for it? What is journal entry to account for it? Investments account debit, investments account debit to SBP reserve, to SBP reserve. To SBP reserve credit. To SBP reserve credit. Is that clear? Now comes the question how to compute the fair value of the pre-combination award. So I'm discussing that. Okay, fair value of the pre-combination award will be equals to, there is a formula for that. There is a formula for that. Formula is fair value of the original award, fair value of the original award multiplied by expired period till date of acquisition divided by higher of original vesting period or revised vesting period. So now tell me, what is the fair value of the original award? What is the fair value of original award? It is 500. It is 500. Now tell me, what is the expired period till date of acquisition? Let's see in the question. Green Limited acquired Pollution Limited. As part of the arrangement, Green Limited had to replace the Pollution Limited existing equity settled award. The original awards specify a vesting period of 5 years. So original vesting period is 5 years. Let's write here. Original vesting period is 5 years. Okay, now pollution limited employees have already rendered 2 years of service. So what is the expired period till date of acquisition? 2 years. 2 years. 2 years. Okay, now further, what is the revised vesting period? So revised vesting period is expired period plus remaining period. Okay, tell me, what is the expired period? 2 years plus what is the remaining period? So ideally it was 5 years. So out of 5, 2 years we have already serviced. Okay, so 3 years are remaining. But now let's read the question. As required, Green Limited replaced the awards with its own share-based payments award. Under the replaced awards, the vesting period is reduced to 2 years. So the remaining period was 3 years, but they reduced it to 2 years only. So what is the revised vesting period? 2 years plus 2 years. So the remaining period is reduced to 2 years from 3 years. So it is 4 years. So now tell me, what is the value of the pre-combination award? What is the value of the pre-combination award? It is 500 multiplied by 2 divided by higher of 2, 5 or 4, 5. Higher of 5 or 4 is 5. Is 5. Right? So it is equals to how much? 200. Okay. So this entry will be 200. So then what is the relevance of this? What is the relevance of this replacement award? Okay. Now, this is something called as post combination award. So post combination award has a value of fair value of replaced awards minus pre-combination award, which is equals to 600 minus 200, okay, is equals to 400. Now this 400 will be recognized as an share based payment expense in P&L as per IFRS 2 over the remaining revised vesting period of 2 years. Clear everyone? Is it clear everyone? Is it clear everyone? Okay, so the general entry will be employee benefit expense, employee benefit expense debit to SPP reserve. Okay, for over 2 years. Over 2 years. Is the replacement award clear to all of you? Come on guys, please tell me. Guys, the replacement award is a very important concept. It has come in the exam multiple times, and every attempt I have seen students making mistake in the replacement award because they don't study this part only. They don't study this part only. Is that clear everyone? Is that clear everyone? Come on guys, please tell me. How is the jaws, guys? Come on, I can see the jaws going down. I can see the jaws going down. Come on, guys, tell me, how is the jaws? How is the jaws? Come on, guys, tell me, how is the jaws? Tell me, hi, sir. Come on, guys, come on. Yeah, we are studying such a great chapter, 30 marks, short chapter we are studying, and you guys are low on energy. Doesn't look good. Not fair, not fair, not fair. Come on, guys. I need the response from each one of you. How's the Joes? Come on, guys. Come on, everyone. Okay, now Khushi is asking a query, sir, but what if subsidiary had a cash settled payment scheme? Then this concept will not apply. Then this concept will not apply. Okay, this entire concept applies in case of equity settled share based payment scheme. Okay, equity settled share based payment scheme. If it is a cash settled scheme, subsidiary will definitely pay to its own employees. Subsidiary will pay to its own employees in the form of cash. Now, why is a replacement award happening? Because now see, understand, it generally happens in the case when parent is a listed company and a bigger company. Okay, to motivate the employees of subsidiary to remain in the company, to motivate the employees of subsidiary company to remain in the company, parent company says that subsidiary, you cancel your shares. Let's suppose Tata acquired Zomato. Tell me which company shares you will be more interested in, Zomato or Tata? Tell me which company's shares you will be more interested, Tata or Zomato? Tata, definitely Tata, right? So Tata will say to Zomato, please cancel your shares. Please cancel your equity settled scheme. Rather, I will give my own equity shares. This will motivate the employees to remain in the company for a longer period of time. Okay. Now, if it is a cash settled scheme, it doesn't matter whether subsidiary is paying to the employees or parent is paying to the employees. For employees, it doesn't matter. What matters is the cash that is coming in, right? So it doesn't motivate that much. So this concept is not applying in that case. Okay, but still, if you are asking me, sir, what if parent is paying to the employees of subsidiary company? Okay, what is parent is paying to the employees of subsidiary company in the form of cash? So we have to see, why are we paying? If we are paying to acquire the shares, it is added to the cost of investment. But if we are paying to the employees of subsidiary company for the continuing employment, then it is a case of employee benefit expense to be recognized in P&L over the employment period. I believe it is clear to all of you. Coming to question number 7. Now, let's solve this question. Requirement. How the consideration for the acquisition of Hammond be measured on 1st July 20x7? What is 1st July 20x7? 1st July 20x7 is the date of acquisition. Your answer should include a discussion of why only some cost of the replacement share-based payment scheme should be included within the consideration. Why? Niharika Rathi, this is already shared. This Excel file, yes, I'll be sharing with the students who have enrolled with me. I'll be sharing that with them. Okay. In the WhatsApp group, you will find this file. Okay. In the WhatsApp group, you will find this file. Okay. Now, acquisition of Hammond and share-based payments. Laploid company acquired 60% of the 10 million equity shares of Hammond on 1st July 2007. So basically, I'll tell you, question number 7 is the explanation part of question number 6, nothing else. Okay, 2 Laploid shares are to be issued for every 5 shares in the Hammond company. Okay, these shares will be issued on 1st July 2008. The fair value is $30 on 1st July 2007. So let us first of all calculate the consideration amount. Okay, so now fair value of share exchange. I will focus my discussion around the replacement awards. 10 into 60%. to 2 for every 5, 2 for every 5, shares in every 2 to 2 by 5 is the number of shares multiplied by the fair value is 30. Okay, chalo. This is the fair value of share exchange. Now, fair value of pre-combination award. Let us solve and tell me what is the fair value of pre-combination award. Hammond Company has granted a share-based payment to its employees with a 3-year vesting period. This is the original vesting period. Okay, at 1st July 2007, the employees have completed the service period. Service period is already done, but had not exercised their options. The fair value of the options was 15 million. So this is the fair value of the original awards. As part of the acquisition, Lapide is obliged to replace the share-based payment scheme of Hammond with a scheme that has a fair value of 18 million. So this is the fair value of the replaced awards. No other vesting condition attached to this replacement scheme. There are no other vesting conditions. So now tell me what is happening. What is happening here? Original award has a value of 15 multiplied by what is the expired period 3 divided by what is the original vesting period 3, what is the revised vesting period 3. So there is nothing higher. 3 by 3 is 15. So it is 15 million is the fair value of the pre-combination award. So this is the value of your investments. This is what we have to find out. Okay, this is what we have to find out. Okay, now the question says you have to explain why only a part of the what is the fair value of replaced awards. What is the fair value of replaced award? 18 million. But why only 15 million of it is added to the cost of investment? So why? So the answer for that is, understand. Answer for that is, out of fair value of replaced award of $18 million, $18 million, only 15 million forms part of cost of investment. The remaining 3 million will be expensed off in P&L as employee benefit expense as per IFRS 2 on share-based payments. Okay, why? But the question is why? Why? Because the reason is up to 15 million represents proportionate value of original award for which Hammond has received services from its employees. Okay, and hence ideally Hammond has to settle this. But who is settling? But Lapide is settling this on behalf of Hammond, and hence we add this to cost of. Think of it like this. Okay, now you have this calculator. You guys have this calculator. Okay. Now what I'm telling you is, I want to purchase this calculator from you. So you said, okay, sir, I will sell this calculator to you for $2. But additionally, you have to pay $3 to the vendor from whom I purchased this calculator. Now tell me, from my point of view, how much did I pay to acquire this calculator? How much did I pay to acquire this calculator? I paid $2 to you and I paid $3 to the vendor from whom you purchased the calculator, right? So 2 plus 3, 5 is my investment in this calculator, right? Similarly, right, that company, Laploid company, paid 72 to the acquiree, subsidiary, but this 15 was ideally to be settled by the subsidiary, but subsidiary didn't settle, rather parent is settling on the behalf of subsidiary, right? So it is also a part of the cost of my investment. That's why we are adding it. Is it clear, everyone? Is it clear, everyone? Come on, guys, please tell me. Question number 7, the reason is clear, everyone? Chalo. Question number 8. Question number 8. A Limited acquires 80% subsidiary of S for 3,200. At the date of acquisition, B Limited, this question is again coming from the CA final book. Okay. At the date of acquisition, B Limited's identifiable net assets is 3,000. NCI is measured at proportionate share of identifiable net assets. So the goodwill on date of acquisition is 800,000. Okay. Now, at the end of the next financial year, B Limited's carrying amount is reduced to 27,000 excluding goodwill. Now, just first of all, tell me, if NCI is at proportionate share method, the goodwill that we compute is full goodwill or partial goodwill? Is full goodwill or partial goodwill? Come on, guys, tell me. The goodwill that we compute is full goodwill or partial goodwill? Come on, guys, please tell me. If NCI is at proportionate share method, the goodwill that we compute is full goodwill or proportionate or partial goodwill? Come on, guys, I need the answer from each one of you. I need the answer from each one of you. It is partial goodwill. Very good. It is partial goodwill. For the students who are asking me whether they will get the recorded session for these or not, so on YouTube, it is only live. Okay. For the students who are enrolled in my paid batches, they will get the recording of it. Okay. Now, NCI is proportionate share method, goodwill is partial goodwill. Okay. Now, how to calculate impairment loss? How to calculate impairment loss? So understand, case 1. Case 1. Case 1. What is the carrying amount of net assets? What is the carrying amount of net assets? Tell me, please. What is the carrying amount of net assets? It is how much? 2,700. Now, what is the value of your goodwill? It is 800. Okay. Now, what is the recoverable amount? What is the recoverable amount? Recoverable amount in case 1 is 2,000. But please understand, this recoverable amount is for 100% of the subsidiary. This carrying amount is for 100% of subsidiary, but this goodwill is a partial goodwill. It is represents only 80% of subsidiary, right? So to make it comparable, to make these comparable, we need to add the 20% goodwill extra, which is called as the concept of notional goodwill. And how will you compute this? So you will say 800 is for 80%. Then what is the amount for 20% goodwill? 200, right? So what is the value of your net assets? 3700. Okay, and this is the carrying amount and RA. So what is the impairment loss? Impairment loss is this minus this, 1700. Now how will this be allocated? It will be allocated to goodwill. It will be allocated to net assets. Goodwill how much? 1000. Net assets how much? 700. Now how much for parent and how much for NCI? Okay, so parent will take 80%, 0.8. NCI will take 20%. Okay, similarly this also. But now understand, is the goodwill for NCI recognized in the goodwill for NCI recognized in SOFP? No. So can we recognize the impairment of goodwill of NCI? Impairment of goodwill attributable to NCI, can we recognize this? No, we can't recognize this. No, we can't recognize this. Okay, strike through. We can't recognize this. Okay, so now goodwill, therefore goodwill is impaired by 800. Wholly it will go to console RE, parent only parent. Okay, now net assets are impaired by 700. Okay, now console RE 560 and NCI is 140. Is that clear, everyone? Case 1. Now moving on to case 2. Moving on to case 2. What will happen in case 2? In case 2, how things change in case 2? In case 2, the recoverable amount is 2800. Okay, so this is same in case 2. Goodwill, notional goodwill same, carrying amount same, only the recoverable amount changes from 2000 to 2800, giving an impairment loss of 900. So will there be any allocation of impairment loss to the net assets? No, it will be 900, it will be 0. Okay, so now parent will take 720, NCI will not be. Okay, so goodwill is impaired by 720. Console RE, net assets are not impaired. Is that clear, everyone? Is that clear, everyone? Come on, guys, please tell me. So basically what I'm trying to say here is, if I have to give you the crux of it or the conclusion of it is, the crux of it is, if NCI is at proportionate share method, goodwill, it is a case of partial goodwill. Now, when you have to test the subsidiary for impairment, you have to add notional goodwill to make carrying amount comparable with that of recoverable amount, okay. But now we need to be very mindful, that we do not recognize, please understand, we do not recognize notional goodwill in FS. Hence any impairment for notional goodwill is also not recognized. Okay, is that clear, everyone? Is that clear, everyone? Question number 8. Is that clear, everyone? Question number 8. Moving on to question number 9. Okay, but what we can do is, before question number 9, okay, we can take a break. Okay, but whatever are the queries, let me take up the queries. So the impairment of NCI is not allocated to them, but how can we see the overall impairment in FS? the impairment of on NCI is not allocated to them. Impairment on NCI only for the goodwill part. For the net assets, we do recognize, na? For the net assets, we do recognize. You see, impairment of net assets on the NCI is recognized because NCI do take their share of net assets. Okay, whether NCI is at proportionate share method or NCI is at fair value method, NCI takes the share of net assets definitely. But NCI takes the share of goodwill only if NCI is at fair value method. If NCI is at proportionate share method, NCI doesn't have its own share of goodwill. Hence, any goodwill impairment will not be allocated to NCI. Is that clear now? Is that clear now, everyone? Okay. So now with this, we complete 8 questions. Okay. With this, we complete 8 questions. Now let us take a break of 15 minutes. Let us take a break of 15 minutes. And then we will resume back. Shall we resume back? Come on, guys. Back from break, everyone. Come on, guys. Let's be back from break and bang on here. Come on, guys. Everyone. Shall we resume back? Chalo, let us start the discussion. Okay, and this question I can say is one of the most, one of the best questions, one of the important questions. Okay, I can say with absolute guarantee, I can say that. Okay, chalo, let us discuss. Draw. Now, Laploid company is a parent company of a group undergoing rapid expansion through acquisitions. Okay, the current financial year end is 30th June. Hey, why is this? Just a minute, guys. Okay, ठीक है, this is working at least. चलो. Now, okay, the current financial year end is 30th June 20x2. 20x8 is the current financial year end. Let's read the requirement first of all, and then we'll come to the scenario. Always have this mind, guys. Never read the scenario first of all, or else you will just be struggling to understand the scenario itself. You will not be able to find the answers. The intent is to find the answers, right? So don't read the scenario first. Always go and read the requirement first, and as per the need of the requirement, we will read the scenario. Okay, chalo. Point number one, how the fair value of the factory site should be determined at 1st January to 1st July 2004, and why the depreciated replacement cost of 17.4 million is unlikely to be the reasonable estimate of the fair value. Okay. Now, so basically, question is saying why the factory should be, how the factory's fair value should be determined. So now, point number one. Requirement. Let us understand the requirement. How should the fair value of factory site determined? This is requirement number one. And what else then? Okay. And why? Then the next requirement here is why the depreciated value is an unreasonable estimate. Unreasonable estimate. Okay, so now tell me, can we define fair value? Can we define what is fair value as per IFRS 13? Can we define what is fair value as per IFRS 13? So fair value is the price that is expected to be received on sale of an asset, okay, in an orderly transaction, between market participants, at a particular date. This is the meaning of fair value. This is the meaning of fair value. Now tell me, when we determine the fair value of any particular, here you can say factory site. Is factory site a financial asset or a non-financial asset? It's a non-financial asset. It's a non-financial. For valuation of a non-financial asset, tell me, what do we need? The entity needs to evaluate needs to evaluate all the possible alternative uses of the asset, all the alternative possible uses of the asset, and then determine highest and the best use, considering the highest value and all possible restrictions Okay, now what the value under highest and best use, okay, is considered as fair value, Now whether irrespective whether or not we are using under that highest and best use, let's suppose this studio, okay, this studio is a commercial property, but let's suppose in this area residential property is of highest value, okay, but I'm not using this studio for residential purpose, I am using it for commercial purpose, okay, doesn't matter, okay, what purpose you are using for doesn't matter, you have to see what is the highest and the best use. So now, okay, then you can say we are not required to be not entities. Fair value is not something entity specific, no, it is not entity specific value, no. Fair value is asset specific value. Okay, chalo, let's read the exhibit now. Laploid acquired 80% of the 5 million equity shares of Coalition on 1st July 2004 for $90 million. Fair value of NCI on the date of acquisition is 22 million. Fair value of the identifiable assets is 65 million, except the following. Excluding the following asset. And now what is that asset? Coalition purchased a factory site. Coalition is a subsidiary. Purchased a factory site several years prior to date of acquisition. Okay. The land and the property prices in the area have increased significantly in the years immediately prior to 1st July 2004. The nearby sites has been acquired and converted to residential use, but we are using it for what purpose? Factory. The nearby areas are converted to residential use. Okay, now it is felt that Coalition site should be converted to residential use. The factory site would have a market value of the factory site. Okay, now it says that the question is saying it is felt that the Coalition site, if the Coalition site is converted to residential use, the factory site would have a market value of 24 million, and 1 million is the cost that would be incurred to demolish the factory and obtain planning permission for the conversion. Coalition was not intending to convert. They don't want to convert, but it says that if they will convert, this is the value that they will get. Okay. Now the depreciated replacement cost of the factory on 1st July 2004 has been correctly calculated at 17.4 million. Okay, now understand. Highest and best use here is residential purpose. Okay, fair value under that is 24 minus 1 is equals to 23 million. Okay, we will not consider depreciated cost as it is not the highest and best use value. Simple. Tell me, is that clear? Part A over for how many marks? 7 marks. We have written all the points. Tell me, is that clear, everyone? Is that clear, everyone? Okay. Chalo. Part 1 done. Part B. What is part B? What is part B of the question? See here. Calculate goodwill. Calculate goodwill on acquisition if NCI is measured at either fair value or proportionate share method. Chalo, let us compute that also. If NCI is at fair value method now, or if NCI is at proportionate share method, in both the cases, how will you compute goodwill? So now tell me, what is the value of your investment that is given in the question? In my opinion, the value of your investment is 90 million. But please understand, this 90 is same. Okay, this investment is 80%. Okay, now what is the value of NCI? Value of NCI fair value is given as 22 million. Okay, what is net assets? So net assets question is giving us the data as 65 million is the fair value plus 23 million is the fair value of the property. So 65 plus 23 is 88. So minus 88 is the value of the net assets, which will remain the same here. But if NCI is a proportionate share, we have to take the 20% of 88. Okay, now this is how. So what is your goodwill? What is your goodwill? Add up 24 and 19.6. This is how the computation of goodwill will work. So now part 2 is also fairly answered. For 3 marks, we have calculated the goodwill. Is that clear, everyone? See, part 2 just says calculation of goodwill. Is it asking us to explain? No. Will we explain? No. Okay, chalo, part C. Now part C is the important part of this question. Okay, part A and part B was simple. Part C is why I have taken up this question for. Okay, part C is the reason why we are discussing, part B is the reason why we are discussing this question. Question says calculate and allocate collision company's impairment loss. So it is asking us to calculate and allocate impairment loss of subsidiary, that is Collision Co. Subsidiary Collision Co. Okay. Okay. And a discussion, and you have to discuss why the impairment loss of Collision Co. would be differing on how NCI is measured. So now, if NCI is at fair value method, and again I have to do the same thing if NCI is at proportionate share method, and then I have to discuss why the treatment under these two parts are different. And then I have to discuss why the treatment under these two parts are different. Okay, so first of all, let us understand. But on what date? On 30th June 20x8. We have to do this analysis on 30th June 20x8. Okay, let us understand and solve it. Okay, chalo. So this is about the impairment of Collision, incurred losses, and the net assets on the date on 30th June 2008 is given. Land and building, plant machinery, intangibles, current assets. Current assets. Okay, now additionally we will also write goodwill. But please understand, since NCI is at fair value method, goodwill will be full goodwill. Okay, now what is the values carrying amount? Okay, what is the values? 60, 15, 922, 60, 15, 922. Goodwill is how much if NCI is at fair value? 24. Goodwill is full goodwill. Okay, so now we have, what is the carrying amount total? This much. What is the recoverable amount? Question would have mentioned about the recoverable amount also. Please say in the question, the recoverable amount of the assets is 100 million. So recoverable amount is 100 million. So what is the impairment loss? 30 million. Comes the question, how will you allocate impairment loss? How will you allocate impairment loss? Okay, now for that, the question says that included in this assessment was a building owned by Collison Company, which was impaired by 4 million. So there is an asset which is explicitly impaired. So first of all, let's impair this by 4. So total impairment will be 30. Total impairment will be 30. Out of which, first of all, we have impaired the land and building by 24. Then we will impair the goodwill wholly by 24. Okay. What is the remaining impairment loss? What is the remaining impairment loss? 24 plus 4, 28 done out of 30. Now tell me, will we impair current assets? No. So we have to impair plant machinery and intangible assets. The total impairment is 2. The remaining impairment loss is 2, which has to be allocated to these two in the ratio of their carrying amount. So how? Minus 2 multiplied by 15 divided by 15 plus 9 is 24. Similarly here, minus 2 multiplied by 9 divided by 15 plus 9 is 24. This is how we allocate the impairment loss. So what is the revised carrying amount? What is the revised carrying amount after allocation? Okay, so this is the revised carrying amount after allocation of the impairment loss. Now, how will things work if NCI is at proportionate share method? Okay, now please see. So the goodwill under NCI at proportionate share method is 19.6. Okay, goodwill is 19.6. But please understand that we need to add notional goodwill. Why? Because this goodwill is partial goodwill. Since NCI is at proportionate share method, goodwill is a partial goodwill, and we have to include the concept of notional goodwill, and it will be 19.6 divided by 0.8 into 0.2 is 4.9. Okay, so if you add up everything, it becomes 130.5. Recoverable amount is 100. Impairment loss is 30. Now again, first of all, I will impair this by 4. Then I will impair the goodwill wholly, 19.6 minus 4.9. Okay, done. Okay, then what else? Total impairment loss is how much? 30.5. Out of which we have already impaired 28.5. Current assets we are not required to impair. So we have to impair plant and machinery and intangible assets. By what amount? Same thing here. Now comes the question. How are things changing? Is there any difference for land building, plant machinery, intangible, current assets? No. Goodwill. Is there any difference? Yes. Goodwill is a difference. But now let's read the question again and try to understand how should we structure our answer. The calculation and allocation of impairment loss on 30th June 2008. Have we shown the calculation and the allocation? Yes, we have shown. And now the question is saying a discussion of why the impairment loss of Collison Company would differ from depending on how NCI is measured. Okay, why the impairment loss would be differing? Why it will differ? Okay, your answer should include a calculation. We have given a explanation of how the impairment would impact upon the consolidated financial statements of Laploid. Okay, chalo, let us first of all discuss the impact and then we'll discuss the why. Okay, now impairment loss of 30 first allocated to land building, right? Building allocated to building, how much? 4 million. Then secondly, allocated to goodwill, how much? 24 million. Then remaining impairment loss is equals to 30 minus 4 minus 24 is equals to 2, will be allocated to remaining applicable assets in the ratio of their carrying amount. Now, how will things work if NCI is at proportionate share method? First of all, impairment loss of 30.5, first allocated to building, second allocated to goodwill, how much? 24.5. Parents share is 19.6, only recognized, meaning thereby NCI share of goodwill impairment is not recognized. Why? Because NCI's goodwill is not recognized, hence the NCI share of goodwill impairment is not recognized. So the remaining impairment loss is 30.5 minus 4 minus 24.5 is 2, will be allocated to remaining applicable assets in the ratio of their carrying amount. Okay, now, so we have discussed the impact on the consolidated financial statements also. Now our answers would be why the difference between NCI at proportionate and fair value. Okay, the difference is because if NCI is at proportionate share method, the goodwill computed is for parent only, that is partial goodwill, and hence we need to add notional goodwill, okay, just to make carrying amount comparable with that of recoverable amount. Okay, now this notional goodwill is not recognized in financial statements, hence any impairment loss on goodwill, on notional goodwill, is also not recognized. Tell me, is it clear, everyone? Is it clear, everyone? Come on, guys, please tell me. Is that clear, everyone? Come on, guys, please confirm if it is clear, everyone. Okay. Now, moving on to the next question. Sorry. 9 is done. Moving on to question number 10. Okay. Karma is saying, how long will the session go? You are required to attend the session, Karma. I am taking the session. Okay, so why are you feeling low on energy? Don't feel low on energy. Okay, see, ideally the session would go for somewhere in the range of, you can say, next 3 hours, but I am not, see, I'm not hesitant here. I have a target which to be achieved, and I will take all the questions in this session, and then only I will wrap up this session. Okay, I have somewhere in the range of around 21 questions to be discussed. Okay, and few questions to be given as an assignment, okay, which I will discuss, and then only I'll wrap up this session. Okay, and then only I'll wrap up this session. The intent here is to help you get that required level of confidence. Now coming on to question number 10, which is from reacquired rights. Now again, this is an area where a student forgets, a student doesn't study this, and again examiner time and again they have asked this question. Okay, now reacquired rights. Now there are two adjustments for reacquired rights. One adjustment is from the point of view of purchase consideration, and one adjustment is from the point of view of net assets. So what is the adjustment happening here? Understand please. In net assets, we add fair value of reacquired rights, okay, to net assets of subsidiary. Fair value of reacquired rights on date of acquisition to net assets of subsidiary. Okay, and what is the treatment in purchase consideration? Reduce purchase consideration, or you can write investments, by lower of A, fair value on date of acquisition, or B, settlement amount. Now read this question and try to answer that follow. ABC Limited acquires PQR for a consideration of $1 CR. Okay, $1 CR. So what is the purchase consideration given in the question? 100 lakhs. Okay, now 4 years ago, ABC Limited had granted a 10-year license allowing PQR to operate in Europe. The cost of the license was 250,000 and it was for 10 years. The cost of the license was 250,000 and the life was 10 years. So what is the amortization per year? 25,000. So it was issued 4 years ago. So what is the amount that is already amortized? 25,000 into 4 is 100,000 is already amortized. So what is the unamortized fee? 250 minus 100 is 150. 150. Okay. Now, the party allows to terminate the contract at the unexpired fee, that is 150 plus a penalty of 20%. Okay, so 150 ka 20% is 30,000. So 150 plus 30 is 180. So settlement amount is, what is the settlement amount? Was it settlement amount? Settlement amount is 250 into 6 by 12. That is given in the question. 250 into 6 by 12. That is 150. That is not 12. 6 by 10. 6 by 10. 6 by 10. Okay, that is 150. Then plus 20% of 150, that is equals to 180,000. Okay, what is the fair value on date of acquisition? So now the question says the fair value, okay, calculates under current economic and the current prices, price of 450,000. The fair value is 450,000. Fair value is 450,000. So it will reduce by lower. So, and therefore, purchase consideration will reduce by 180,000. Therefore, hence, revised purchase consideration is equals to 100 minus 100 lakh minus 1.8 lakh is equals to 98.2 lakhs. Okay, now what net assets will increase by? Net assets will increase by 4.5 lakhs. Simple. This is the treatment. This is the treatment of reacquired rights. This is the treatment of reacquired rights. Simple. Okay. Chalo. Moving on to question number 11. This is a question from deferred tax. Again, a very interesting question, but a student generally forgets this. Now I will give you a simple funda for deferred tax. I'll give you a very simple funda for deferred tax. Okay, understand. If there is a fair value gain on date of acquisition, then on that fair value gain, you will recognize deferred tax liability. If there is a fair value loss on date of acquisition, then on that you will recognize deferred tax asset. Okay. Now, in the post period, in the post acquisition period, if you have any expense or if you have any losses, on that you recognize deferred tax asset. In the post period, if you have any incomes or if you have any gains, you recognize deferred tax liability on that. That's the very simple funda for creation of deferred tax asset or a deferred tax liability in the case of a business combination transaction. In the case of business combination transaction. So let us solve this question. Okay. Now, if you read this question, the question asks you to compute deferred tax on the above, and then after computing deferred tax, calculate the goodwill arising on acquisition. Okay, so now let us understand and solve this question. On 1st April 20x1, sorry. On 1st April 20x1, A Limited acquired 12 crore shares representing 80% stake in B Limited by way of a cash payment of 25 crore. Okay, investment 80%, 25 crore. Okay, it is the group's policy to measure NCI in the subsidiary at the date of acquisition fair value. The market value of equity share in B Limited can be used for this purpose. Okay, chalo. So what is the fair value of NCI? It will be okay, how many shares? So 12 crore is the shares acquired by parent. This represented 80% stake. So what is a 20% stake? Okay, so this is the number of shares held by NCI. Multiply, what is the fair value per share? 2. Chalo. So now we need just less fair value of net assets. Fair value of net assets. Okay, so you can write your working note 1. Working note number 1. Net assets. Fair value of net assets. Okay, now, so it says the net assets carrying amount of net assets given in the question is 23. Then what else? Now the question goes on to state that the property having a carrying value of 15 had an estimated market value of 18. So property fair value adjustment on account of property is how much? 3 crore. Now fair value adjustment on account of plant is how much? Just see here. Carrying amount of 11 and market value of 13. So 2 crore. Then inventory. Fair value adjustment of our inventory. Okay. So cost is 2.5 and fair value is 3. So it is 0.5. Now, so these are the fair value gain. 3 plus 2, 5. 5 plus 0.5 is 5.5. So these are fair value gain. So on these, we have to recognize deferred tax liability on fair value gain. How much? 5.5 multiplied by, what is the tax rate? 20%. Tax rate is 20%. So what is the amount? 1.1. Okay, so what is your net assets? It is 27.4. So here you can write minus 27.4 and your goodwill will be equals to this much, 3.6. This is your goodwill. So the intent behind taking up this question was the discussion of this deferred tax liability, and I believe you have understood this concept. I believe this you have understood this concept. Is that clear, everyone? Come on, guys, please tell me. Is that clear, everyone? Come on, guys, please tell me. Is it clear to all of you? Is it clear to all of you? Wonderful. Coming to question number 12. Are you getting the confidence? Come on, guys, please tell me. Are you getting that confidence? Question number 12. Luna is a parent company. Just a minute. Explain with calculations how the disposal of shares in Starlight should be accounted for in the console financial statements for the year ended 31st March 20x6. Explain with calculations how the disposal of shares in Starlight should be accounted for in the console financial statements. Disposal of shares in Starlight. Okay. So now let us see. See, disposal can be of multiple times. It can be disposal of subsidiary. It can be disposal of shares, but not leading to loss of control. So we need to see what exactly is happening here. Okay. So now question says that on 1st April 2002, on 1st April 2002, we acquired, the Luna company acquired 80% of Starlight. Okay. Now, Starlight company had in issue 1 million equity shares. Equity share capital is 1 million and has not issued shares for many years. Okay, fine. Goodwill on acquisition is 0.32 million. Goodwill on acquisition is 0.32 million and has subsequently been impaired by 50% in 20x4. So in 20x4, we have impaired the goodwill by 50%, 15%. Okay, goodwill impairment by 15%. Okay, fine. What next? What's next? Let's just understand the data of the question first of all. Now, Luna values non-controlling interest at fair value. Luna values non-controlling interest at fair value. Okay, so let me write that NCI is at fair value method. What else? The fair value of the net assets of Starlight on acquisition exceeded the carrying amount by 200,000. So now it says on this date fair value adjustment was 200,000. Okay, and this is on account of a non-depreciable land. Okay, fine. What else? On 1st January 2006, on 1st January 2006, Luna sold 100,000 equity shares. Sold 100,000 shares. Now 100,000 shares out of 1 million. So meaning thereby sold 10%. Okay. Minus 10%. Is it a loss of control? Is it a case of loss of control? Is it a case of loss of control? No. No, it is not a case of loss of control. It is not a case of loss of control. It is disposal of shares without loss of control. It is a disposal of shares without loss of control. Now tell me what happens here. If the shares are disposed without loss of control, your NCI increases. Your NCI increases. Okay. You receive funds. Okay. Sale proceeds are recognized. Any gain or loss will go to where will it go? Where will it go? Will it go to P&L? Nah, it will go to other equity, particularly I can say retained earnings. Okay, now comes the question. How will NCI increase? How will NCI increase? So NCI will increase proportionate, okay, that is net assets plus goodwill multiplied by 10%. At this value, NCI will increase. So this is the discussion that I had. Okay, this is the discussion. Now we need the values. We need the values. Okay, tell me. So entry will be bank account debit to NCI, okay, credit, and the difference will go to other equity, okay, to equity credit. Now we sold the shares for $7 a share, 100,000 into 7, 700,000. Now comes the question, at what value shall we increase the NCI? We need the value of net assets. We need the value of net assets. We need the value of goodwill. So goodwill on date of acquisition, we know. Goodwill on date of acquisition, we know as how much? 320,000. Okay, impairment is 15%. So this into 0.15, 48,000. So goodwill value now on 1 January X6 will be this minus this. This is the value of goodwill. Now we need the value of net assets also. We need the value of net assets as well. So let's see what is the data given in the question for net assets. Only reserve within the equity in the individual financial statements is this one. The balance of this reserve is 4658 on 1st April 2005. Generated a profit of 165056 accrued evenly throughout the year. Okay, so now tell me equity share capital. What is the equity share capital? Tell me of Starlight 100,000, 1 million. Equity share capital is 1 million. Okay, 1 million. Now retained earnings at 1st April 2005 is how much? 4658,000, 4658,000. Okay, now profit till 1 January X6 for how many months? For how many months? So 165056 multiplied by April, May, June, July, August, September, October, November, December, 9 months into 9 by 12. Okay, so this is the profit till 1st January. Now fair value adjustment that we have done on date of acquisition, since it was done on non-depreciable asset, we would not have done depreciation of it, that is 200,000. So what is the net assets? Add up. It is 59,81792. It is 59,81792 and goodwill is this much. So what is the value of NCI? So NCI will increase by this plus this multiplied by 10%. $625,379.2. At this value, your NCI should increase. And the difference will go to retained earnings. Is that clear, everyone? Is that clear, everyone? Okay. Now you, when explaining, how will you explain? First of all, you will explain that this one, that you should increase NCI by the proportionate share of net assets and the goodwill. You will recognize sale proceeds. You will transfer the gain or loss to other equity. Now you should also write why are you transferring to other equity, because this is a transaction. This is a transaction for transfer of equity shares between two equity participants. Hence, any gain or loss arising on this will go to equity, that is retained earnings. Is that clear, everyone? Come on, guys, please tell me. Is that clear, everyone? Come on, guys, please tell me. Is that clear, everyone? Wonderful. Guys, tell me, are you enjoying the session? Are you understanding? Are you getting confidence? See, we are already at the mid of it. We are already at the mid of the session. Tell me, are you enjoying? Are you understanding? Are you getting confidence? Now, there is one query coming up from, sir, what is the meaning of equity participants? Okay, now understand, if this company is Starlight, okay, now Luna is a parent company holding how many shares? 80%. Holding 80%. Now, NCI parent Luna is a shareholder of Starlight holding 80%, right? Now, NCI is also a shareholder. Please understand, NCI is also a shareholder of Starlight holding 20%. Now, because of this transaction, this is decreasing by 10% and this is increasing by 10%. Both of them are equity holders of Starlight. Both of them are equity holders of Starlight. That's why we call them a transaction between equity participants. Is that clear, everyone? Is that clear, everyone? Come on, guys, tell me, please. Okay. Now, see, I'll tell you guys, the intent behind these session is to help you understand concept by concept. How will you apply these concept by concept in these sessions? Okay. Now, as I have shown you in the very beginning of the session also, and I'll tell you now also, these will help you build the concepts. But solely practicing the questions doesn't mean that okay, group accounting is over. No, you are required to solve full-fledged questions of group accounting after this. You are required to solve full-fledged questions of group accounting after this. You are also required to solve mock test papers after this. Okay, at least I can say not 1, not 2, not 3, not 4, not 5, at least 6 mock test papers. Sir, which mock test papers? The ones that are there in the ACCA practice platform. Okay, ACCA practice platform. For the students who are already enrolled with me in the either SBR regular batch or the SBR crash course, you guys need not worry. I will be discussing the full-fledged questions also with you guys. I will be discussing the 6 mock papers also with you guys. Need not worry at all. I am there for you guys. I'm there for you guys. Okay. So this session is a bridging session from the concept and the exam level question. This is a bridging session which I am taking up, okay, which will help you understand how to apply the concepts in a given case scenario. Now, Khushi is asking, also, sir, what if the question mentioned that the selling of share has occurred with a third party other than NCI? Then in that case, fine, then this is not the case. This will not be the case. Okay, so please understand. Please understand. Please understand. Is this question mentioning? Read this. Please read this. I understood your query now. Yes, very good. Very good point. The student has already answered that. Is this question mentioning anywhere that I have sold my shares to NCI? Tell me. Is this question mentioning anywhere that I have sold my shares to NCI? No. If I am the parent, then all other shareholders are the NCI for me, right? If I sell to anyone, they become NCI. They become NCI. If I sell to anyone, they become NCI, right? The NCI are the equity participants. NCI are the equity participants, right? So please understand, NCI are equity participants. I am the parent. So it's a shift of holding from 10 from here till here, okay? It doesn't mean to say that I have to sell to the existing shareholders. No, it doesn't mean that way. It doesn't mean that way that I have to sell to the existing shareholders. No, it doesn't necessarily mean that way. It can be that scenario, but it doesn't mean necessarily that I have to sell to the existing shareholders. I can sell it to anyone, and to whomsoever I sell, they become the NCI. Very good point. Okay, chalo. Question number 13. Question number 13. Now, this is the similar question, but it is talking from the point of view of purchase. Draw. Entity A acquired 60% of entity B 2 years ago for 6,000. %60, 6,000. At that time, the entity's fair value was 10,000. Okay. The company had net assets at a fair value of 6,000, which is assumed to be the book value. So what is the value of NCI? NCI is 4,000. How come 4,000? 10,000 is equals to 10,000 into 40% less. Okay. Okay. Question is given the goodwill. Oh, question has already computed goodwill. Question has already computed goodwill. Question has already computed goodwill as 2,400. Okay. Question has already computed goodwill. Now, so basically it says 2 years ago, I purchased uh, 60% at 6,000 and the goodwill computed was 2,400. Okay. Now, on 1st October 20x0, entity further acquired 20%. Further acquired 20%. Okay. Taking the holding to plus. Taking the holding to 80%. Okay. It's a purchase of shares. It's a case of purchase of shares. At that time, the fair value of the entity B is 20,000 and entity pays 4,000 for the 20% interest. So now tell me what will happen here. So we are just required to pass the journal entry for this transaction. So now tell me, since we are purchasing, understand, since we are purchasing, NCI will now decrease. NCI now will decrease. NCI now will decrease. So it will be NCI debit to bank. Tell me now in this case, are we purchasing specifically from the NCI or from anywhere else also? Can we purchase from anywhere else? No, we have to purchase from NCI only because the remaining shares are held by NCI. So we do not have any option to purchase from elsewhere. Are you getting my point? We do not have an option to purchase from elsewhere. We have the 60%, 40% is held by NCI. So we have to purchase from the NCI. We have to purchase from the NCI. Okay, so NCI account debit to bank. NCI account debit to bank. Credit. How much money we have paid to acquire this? 4,000. Now, NCI is reducing. So how to reduce NCI? Reduce NCI proportionately. Reduce NCI proportionately. What is the value of NCI? Carrying amount of NCI is 4,000. 4,000 represented 40% NCI. We have to reduce 20% NCI. That is equals to 2,000. So NCI will reduce by 2,000 and the difference will go to RE debit 2,000. Tell me, is that clear, everyone? Is that clear, everyone? Come on, guys, please tell me. Is that clear, everyone? Come on, guys, please tell me. Question 13. But understand, guys, in question number 12 and question number 13, let me just share you a crux of purchase or sale of shares without loss of control. Okay, okay, without change of control, I can say, without change of control. Now understand, if you purchase, so it means what? NCI reduces. NCI reduces. So decrease NCI proportionately. Okay, decrease NCI proportionately. Decrease NCI proportion, that is NCI divided by NCI percentage multiply by purchase percentage. But okay, now if you sell, NCI increases. Okay, increase NCI with respect to value of net assets and goodwill. How? Is equals to net assets plus goodwill multiplied by the sale percentage. Please keep this in mind. One additional point which you need to be take care of is in both the cases, gain or loss goes to equity, that is retained earnings. Both the cases. So this is the crux. This is the crux. I believe this will definitely help you in your understanding. Is that clear, everyone? Is that clear, everyone? Because the gain or loss on these transactions goes to retained earning or equity. Okay, you can write equity also here. If you want to write equity, you can write equity. No challenge. RE is also a part of equity, right? Since it is a transaction between equity participants, we transfer the gain or loss to equity retained earnings. Okay. Chalo. Question number 14. Question number 14 is not doesn't have any. This you can solve as an assignment. Question number 14. Question number 14 is a question which you can solve as an assignment. That's not a challenge at all. Okay, you can solve as an assignment. Okay, it's a very easy question. Now I'm moving on to the other questions. Just give me a minute. Part B. An important question. I am reaching question number 15. Okay, so now the question which I'm giving as an assignment, you have to solve those questions, and if in case you face any queries in that question, I will be there to help you out with the same. Okay, now chalo. Okay, before starting question number 15, let's take a quick 5 minutes break. Just 5 minutes break. Okay. Let's resume, guys. Is everyone back from break? Can we resume? Can we resume? Come on, guys. Why are you so low on energy? Come on, everyone. I am so enjoying this class, yaar. What about you? Okay, now tell me, just tell me, guys. Okay, see, we are out of 24 questions. Okay, 3 4 questions will be assignment questions. Okay, I think roughly we are discussing 20 questions. Full project we're discussing, out of which we have discussed 14 questions so far. Are you getting confidence? I need to know that. Are you getting that confidence in group accounting now? Are you understanding the concepts? I believe, see, in the past also I have taken multiple times the revision of group accounting. I've taken the revision of group accounting multiple times. But I believe this way the discussion of the questions serves as a better revision of group accounting. What do you say? Come on, guys, please tell me. Be active, yeah. Come on, come on, come on. Tell me. Right? Chalo. Very good. Thank you, guys. Thank you. Now, let us discuss question number 15. Thanks, Kusi. Chalo. Now tell me, shall we read the scenario first? No, bhai, no, 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 no. First of all, let's read the requirement. Let's read the requirement. Okay. Now, advise the directors of Sterling Company with illustrative calculations how the 30% investment in malting company should be accounted for in Sterling individual and console financial statements. Okay. Okay, now how the 30% investment in a malting company should be accounted for in Sterling companies, individual and the console financial statements. Having not read the scenario, I can say it might 30% might be definitely not a subsidiary. It appears to me, it can be. But it prima facie, it appears to me that it is not a case of a subsidiary. It can either be a associate, or it can be a joint venture, or it can be you can say a joint operation might be, right? Or it can be joint operation might be. Let's read the question for that matter. Let's read the question for that point. Okay, now Sterling Company is currently preparing its individual and consolidated financial statements for the year ended 31st March 20x9 in accordance with international financial reporting standards. Okay, now on 1st July 20x9 20x8. On 1st July 20x8, Sterling Company paid cash of 2.5 million and issued loan notes with a value of 1.3 million to acquire 30% equity interest in malting. So can you please tell me what is the cost of your investment? What is the cost of your investment in malting company? It is a cash of 2.5 million and loan notes of 1.3 million. So I can say fair value of loan note. I can say fair value of loan note is 1.3, totaling to 3.8 million is the cost of your investment. Okay, fine. What's next? What's next? The remaining 70% of the equity in malting is owned by two unrelated companies. Okay, now the key operating decisions require unanimous consent of the three investing parties. Understand what is happening here. Okay, now Sterling Company purchased 30% of malting. So now it says, so it's if it is a malting, so what I'll do is I'll show it here. I'll show it here in my notebook. I think that will give you a better picture of the things. Ta-da, 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 ta-da. Yeah. See, now I am visible more clearly. Can you guys see me more clearly? Can you guys see me more clearly now? So far, I was just sitting in the corner a little bit. Now I am, see here. Okay, now let us understand this scenario, what is happening here. Okay, now understand. So there is a company called as Malting Company. Okay. I was missing iPad here. I was missing the use of iPad. Okay. I was missing the use of iPad. I love drawing diagrams and explaining to my students. Okay, I love drawing diagrams for each and every concept. Okay, if you have been in my regular batches, okay, you will realize I love drawing. Okay, now so Malting Company and Sterling Company purchased 30% of Malting. Okay, then rest 70% is by party A. Okay, and party B might be 40%, might be 30%, or might be 35%, 35%. With that, we don't know. The ratio we don't know. But they cumulatively own 70%. Now the question says, if anyone has to take any decision of Malting Company, all three has to come together and take the decision. All three has to come together and take the decision. Solely A and B, can they take decision? No. Solely A and Sterling, can they take decision? No. Solely Sterling and B, can they take decision? No. All three's unanimous consent is required. Now, what is this concept of unanimous consent called as? Again, going back to my screen. Again, I'll be very small, sitting in the corner. Okay, see here. Okay, now. So again, here, please see here. All the key operating decisions requires unanimous consent of all the three investing parties. Okay, so what does this mean? Come on, guys, please tell me, what does this mean? What does this mean? So it is a case of joint arrangement with a joint. It is a case of, since joint control. Okay, now understand. Since unanimous consent is required for all three investing parties to take any operating decisions. To take any operating decisions, all the three parties, unanimous consent is required. Okay, hence it is a case of, this gives rise to joint control, okay, between three parties. Hence this is a case of joint arrangement. It appears that I'm singing song. Okay, right? It appears as if I'm singing songs. Now, if it is a case of joint arrangement, now joint arrangement are of, guys, tell me, no, are you understanding how much to write? Come on, tell me. Are you understanding how much to write? Come on, please tell me. How much to write? Are you understanding that? Because at SBR level, the major challenge that a student faces is how much to write. And for the answers that we know, we keep on writing. For the answers we don't know, we just write something and skip. No, guys. Okay, maintain a balance. Okay, if the question is for 5 marks, write 5 points. That's all. Okay, now while discussing these with you, I just got an idea. Tell me, Shall I take a session? Shall I take a session with you guys in the next week, not this week, next week, wherein I'll guide you the tips and the tricks for SPR, so that you can manage time properly, how you can use the practice platform, what are the hacks that you should use. Shall I take a session on that also? If you want me to take the session on that, so after this session gets over, just write down in the comment box. Okay, I will look at it, and if it is actually required, I will take that session as well. Okay, I will take that session. Okay, I promise I will take that session. But as this session gets over, please write in the comment box. Please write in the comment box. Okay, that sir, yes, please take that session. I will take it up. Okay, I will take it up. I will take it up. No issues. Okay, now, as you know that joint arrangement are of two types. One is joint operation, and second is joint venture. Joint venture. Okay. Now, how to decide whether it is joint operation or a joint venture? Okay. Now, since malting company is a separate entity, and all the parties have the right to share of net assets. Hence, it is a case of, tell me what? Case of what? Joint operation or a joint venture? Joint operation or a joint venture? Tell me. Joint operation or a joint venture? Come on, guys. Joint venture. Very good. I just love you guys. It's a case of joint venture. It's a case of joint venture. Okay. Now, in the case of joint venture, we apply what? Equity method. Okay. So, hence, in consolidated FS, we apply equity method. In individual FS, investment can be measured at either cost or fair value, P&L or other comprehensive income. Now, so we'll measure it at cost. So now, in individual FS, individual FS, it will be at cost. Is equals to 3.8 million. 3.8 million, right? Why? As question is silent on use of fair value. Okay, hence measuring it at cost. Now, in console FS, at equity method. So now, what is the cost? Is 3.8. Now, what is the share of profit? Is it given in the question? Yes. Malting company reported a loss of 0.8 million for the year ended 31st March 20x9 as and a dividend was neither paid nor proposed. Okay, so okay, so I'll write here share of profit share of profit, share of loss. What is amount? 0.8. But this is for the entire year. Tell me, this is for the entire year ending. This is for the entire year ending 31st March 20x9. When have we acquired? 1st July 20x8. So we need the data for 9 months into 9 by 12 into 30%. Minus sales loss. So what is the value? This much. 3.62 is the value. 3.62 is the value. Tell me, is that clear, everyone? Is that clear, everyone? We have accounted for in the individual FS and in the console FS both. Now there is a query coming in from Khusi. Sir, how is the accounting of joint operation different from a joint venture? So in joint operation, we just take our share of assets, our share of liabilities, our share of income, our share of expense. But in case of joint venture, we apply equity method. I'll show it to you. I'll show using an example. I am getting the opportunity to use my, see, I love using the iPad and explaining in that. See here. Let's suppose parent has invested in a joint operation. Okay. Now joint operation has assets, non-current assets, current assets, 100, 20, 120, equity, 40, then non-current liabilities, current liabilities. Non-current liabilities 50, 90, and this is 30. Now this is 120 here as well. So now the standard says that here parent, this party A has fully for parent 10%, then 30% fully parent only. So in the books of parents FS, they will record non-current assets 100, current assets 2, non-current liabilities 30%, and current liabilities wholly 30. This is how I record for joint operation. My share of assets, my share of liabilities, my share of income, my share of expense. Okay, but in case of joint venture, I record my share of net assets. Okay, net assets. It's an ownership interest. Okay, it's a holding of 30% or whatever is the holding. Clear now, Khusi? Is it clear now? In SFS, equity shares are measured at FVT OCI only if the question specifically mentions, Pawan, that the entity has opted for FVT OCI. In that case only we measure at FVT OCI. Okay, otherwise not. I believe it is clear to all of you. Moving on to question number 16. So now this is a question of joint operation. So Khusi, you were asking me now, what is the treatment of a joint operation? So here we have a question of joint operation. See here. Let's read the question. Let's read this question. Draw. Robbie contributed 40% of the cost of constructing a natural gas station and holds 40% share in that gas station. No separate entity was set up under joint operation. So it's a joint operation, okay? Because no separate entity set up, Now, assets, liabilities, revenue, cost are apportioned on the basis of shareholding. So now, understand please. What is the cost of natural gas station? Natural gas station. Cost is 15. Cost is 15. Okay. Now, and natural gas station cost 1.15 million to construct, and the present value of the decommissioning cost is 2 million. Is 2 million. Okay. So now, so decommissioning will be added to this one plus 2. Decommissioning is capitalized to the cost of asset and also recognized as provision for decommissioning, removal, and restoration cost 2 million, right? So now what will Robbie do? What will Robbie's FS do? In the Robbie's FS, they will just take the 40% of it into 0.4. This into 0.4. That's all. This is what is the treatment of joint operation. So in the case of joint operation, we take our share of assets, our share of liabilities, our share of income, our share of expense. There is no share in the net assets. No. Share of assets, liabilities, income, expense. Okay. Chalo. Moving on to question number 17. Now this is a question from associate. Come on guys, please read the question first of all. Please read the question first of all. Let's read the question alongside. Explain with calculations. How explain with calculations? We need to explain also. Guys, tell me one thing. Are you understanding how much to write? At least so far, whatever questions we have discussed, have you understood how much to write? Because that is a very, very important point. That is a very, very important point. Okay, how much to write is a quite very important point. Okay, explain with calculations how the Greer group should account for the investment in GAI in the console FS for the year ended 31st December 2007. Let's read the question now. Acquired 10% interest in GAI on what date? On 1st January 2007. For what value? 23 million. Greer company elected. Oh, see here. As I mentioned right now, someone said, Pawan said, right? Pawan, you mentioned not FBT OCI. See, I told no, if it is at FBT OCI, question will have to specify it. Now see, the question is specifying. Greer company elected the initial recognition to measure at FBT OCI as the investment was not held for trading. See, please understand. Please understand. On 1st January 2007, we acquired 10% interest. Now tell me, this 10%, is it a subsidiary, associate? Is it a subsidiary? No. Is it an associate? No. Right? It's a normal investment to be accounted under the chapter of financial instruments, a normal financial asset by way of investment in equity instruments. In the case of normal financial instruments, investment in equity instruments, by default classification is FVT P&L. But if the question specifically mentions the use of FVT OCI, okay, then we have to use FVT OCI. FVT OCI is an irrevocable option available only and only at initial recognition. FVT OCI is an irrevocable option available only and only at initial recognition. Okay, chalo, come guys. Now further. So this is measured at FVTOCI. What is the cost? Cost 23 million. ठीक है. Now on 1st July 20x7 acquired additional 12%. Now with this 12% you become how much? With this 12% you become how much? 22%. With this 12% you become 22%, and as you become 22% you become associate, either associate or a joint venture, because significant influence comes into the picture. Now let's see what the question says. Let's see what the question says. When you acquire additional 12% interest for 30 million, you achieve significant influence. Question clearly says that. Okay, means if it is an associate, on 1st July 2007, fair value of the previously acquired interest is 26 million. Okay, chalo. So now how will the accounting happen? Question is asking you the treatment in the console FS for the year ended 31st December 20x7. Now understand, on 1st January 20x7, on 1st January 20x7, you will recognize this investment in equity instruments as a financial asset at FVTOCI. Okay, recognize initially at cost of 23 million, and any further fair value gain or loss is recognized in other comprehensive income, that is OCI. OCI. Okay, clear everyone? Clear everyone? Now then we'll write here from 1st January 20x7. Okay, now on 1st July 20x7, what will happen? With purchase of additional 12%, significant influence is achieved. Okay, thereby an associate, hence equity method accounting has to be done going forward. Okay, now say carrying amount of investment is 23 million. Further right here, fair value previously acquired interest on 1st July 20x7, fair value previously acquired interest on 1st July 20x7. Okay, any gain or loss arising, tell me where will that go? Any gain or loss arising on remeasurement, where will that go? Come on guys, tell me where will that go? Will be recognized in, tell me where. Come on guys, tell me where. Is it in P&L? No, because the previous classification was FBT OCI. So it will be recognized in other comprehensive income. So please understand, I'm writing a crux here. Okay, whenever I'm writing a crux here, whenever entity remeasures previously acquired interest, then the remeasurement gain or loss treatment of remeasurement gain or loss is equals to, first, if you are equity method, okay, you were at cost, then P&L. You were at fair value through P&L, then also P&L. Then earlier you were at equity method, then also P&L remeasurement gain loss. But if you were at FBT OCI, if you are at FBT OCI, then OCI. Previous measurement at, okay, remeasurement gain or loss. Tell me, is it clear, everyone? Yes. Yes, agree. Okay, so cost of investment is 23. Fair value of investment is 26. So 3 goes to other comprehensive income. 3 goes to other comprehensive income. Okay, now okay, so what is the cost of investment in associate? What is the cost of investment in associate? Cost of 12%. Cost of acquiring the additional 12% is 30 million. Fair value of 10% previous interest is 26 million. So it is 56 million is the cost of your investment. Okay, now from 1st July 2007 till 31 December 2007. So what will happen in console P&L? Present a single line item. Okay, stating share of post acquisition profits. Okay, now that is equal to, that is share of profit is equals to, share of profit is how much? Share of profit is how much? So what is the profit? What is the profit? Made a profit of 20 million before dividends. So 20 million multiplied by how many shares? 22%. And from 1st July is 6 by 12 into 6 by 12 into 22% is how much? 2.2 million. Now, so this is what is will go to console P and L. Okay, now what will go to console SOFP? What will go to console SOFP? So console SOFP, you will write cost of investment is 56. Okay, share of profit is 2.2. Okay, so value of investment in associate is equals to 58.2. Now the question if you read has other data also. How to utilize that data? Now you must be wondering, sir, you accounted for this one, okay, you accounted for this one, okay, you accounted for this one 26 million, okay, you accounted for this profit of 20 million, okay, but what about dividend? Greer company received a dividend of 0.2 million on 31st March 2007. So now tell me, what was the status? What was the status of investment in GAI on 31st March? So on 31st March, what about dividend? Let me write here. What about dividend? What about dividend received by Greer? So dividend was received prior to achieving significant influence and hence will be recognized in P and L of parent as investment income. Okay. Now tell me, what if dividend was received after becoming associate? Then the share of dividend will be reduced from this investment in associate and will also eliminate from the console P and L as well. Is that clear, everyone? Is that clear, everyone? So now Khushi has a query, sir. When the shift happens from equity OCI to equity method, everything in OCI goes to retained earnings? Yes. Okay. So it's not about everything in OCI goes to retained earnings. I'll tell you. Though it was not a part of the discussion, but since you have asked me a query, let me discuss that with you. Okay. I am adding a separate point and I'm discussing that with you. Okay. Whenever you transfer an investment at FVT OCI to associate, okay, whenever you do this thing, okay, so what happens? Whatever is the gain or loss in other comprehensive income, okay, it is transferred to retained earnings. Okay, so on date of on the date of acquisition of associate, on date of acquisition of associate, fair value gain or loss accumulated in OCI reserve, okay, is transferred to RE. Point number one. Point number one. Point number two. Point number two. If you transfer from investment in associate to subsidiary, if you do this transfer, please understand, guys. Okay, so it is basically equity method. It is basically equity method to line by line consolidation. Tell me yes or no. Tell me yes or no. Right? So now under equity method, we would have recognized share of other comprehensive income of associate also. We would have recognized share of other income of associate also. Right? Now, which will be accumulated in reserves. Right? So now when you transfer from equity method to subsidiary, all these reserves are either transferred to RE or P&L. Now, how will we determine whether RE or P&L? If these reserves are recyclable in nature, then it will be transferred to P&L. If they are non-recyclable in nature, it will go to retained earnings. Okay, sir, can you give an example of recyclable? Yes, foreign currency translation reserve. Okay, cash flow hedge reserve. Sir, can you give example of non-recyclable? Yes, revaluation reserve. Similarly, third point, if you transfer subsidiary, okay, disposed of, if the subsidiary is disposed of, then in that case also parents' share of OCI, okay, is accumulated in reserves, okay, and all these reserves are transferred to either RE or P&L. If reserves are recyclable, then they will transfer to P&L. If they are non-recyclable, they will transfer to revaluation reserve. I believe it is very much clear to all of you. I've discussed all the three possible cases. Okay, that's why if you can recall, in the case of a foreign subsidiary, I discussed the whatever is the foreign currency translation reserve. keep accumulating in the foreign currency translation reserve. Okay, when the subsidiary is disposed of, we transfer the parent's share of FCTR to P and L. We transfer the parent share of FCTR to P and L. Okay. OCI treatment. Question number 17 discussed. Question number 18. It's a similar type of question which I am giving you as an assignment. It is an assignment. It is an assignment question. 18 is an assignment question. Moving on to question number 19. Yes. So 19 we'll be discussing. 19 is a question of foreign subsidiary, a very important question. Foreign subsidiary, a very important question. Okay. $20 is again an assignment. $21 will be discussed. We'll be discussing 21 now. Okay, this will be discussing. 22, 23, 24 are theory-based questions which are given as an assignment. Okay, so now we have to focus on question number 19. And then we have to focus on question number 21. And we will be done with this discussion. $19 and $21 is what we have to discuss now. Okay, chalo. Let me discuss $19 and $21. Question number 19, a very good question. A very good question. It's a question of foreign subsidiary. Chalo. How the functional currency of crotch set will be determined? Okay, let's read the question now. Humming's company is a part of a parent company of a multinational listed group of companies. Humming's company use dollar as its functional currency. Point to be noted here. In case of foreign subsidiaries, please understand what is the functional currency. You will have to be very careful. Okay. Humming's company acquired 80% of the Crotchet company. It's a basically subsidiary. Okay. Now, on 1st January 2004 is the date of acquisition. And 100% of Quaver on the same date. Okay. Okay. Now, question is saying you functional currency, Crotchet. The head of it. Okay, now understand. Since it's a foreign subsidiary, the basic rule of IAS 21 is, okay, in cases of subsidiary, okay, if subsidiary is an extension of parent's business, then functional currency of subsidiary is same as that of parent. If subsidiary is not an extension of parent's business, then it is required to determine functional currency independently. Now, if you read this question, what happens here? See here, the head office of Crotchet is located in a country which uses dinar as its main currency. However, its staff are located in various variety of other locations. Consequently, half of their employees are paid in dinars and the other half are paid in the currency of grommets. Crotset has a high degree of autonomy and is not reliant on finance from Hummings, nor do sales to Hummings, making up a significant proportion of their income. So, meaning thereby what? Tell me, do you think subsidiary is a extension of the parent business? No, no, right? So, subsidiary is required to determine its own functional currency. Now, how do we determine the functional currency? Come on, guys, tell me. How do we determine the functional currency? Come on, please tell me. How do we determine the functional currency? So we determine the functional currency on the basis of multiple factors. There are multiple. There are some primary factors. There are some secondary factors. There are some secondary factors. Now, what are primary factors? What are secondary factors? So primary factors might include, okay, you can say currency which mainly influences, okay, mainly influences the sale price of the goods, okay, cost mainly influences the cost of goods. Now, secondary factors might include costs of running office, might include you can say staff costs, might include funds raised, all those things. Okay. Now let us evaluate what is the question saying. Sorry. Okay. Now, all of its sales and purchases are invoiced in grommets, and therefore Crotset must raise most of its finance in grommets. Cash receipts are retained in both grommets and dinars. Okay, does not own a dollar bank account. Crotset is required by law to pay tax on its profit in dinars. So basically, now tell me, what are the primary factors focusing on? Primary factors are focused around grommets. Grommets, because the sales and the purchase are mostly determined in the form of grommets. For the sake of ease of doing business, I also trade in dinars. Okay, for the sake of doing business, I also trade in dinars, but majorly the influence is of the grommets. So I can say my conclusion will be, definitely you have to write the analysis of this. Okay, but my conclusion will be grommets is our functional currency. Does that make sense? Tell me, guys. Come on. Does that make sense? Tell me, guys, please. Does that make sense? Okay. Now, I have taken up this question for a different concept. My intent behind taking up this question is point number 2, a calculation of goodwill. My intent behind taking up this question is calculation of goodwill. Sorry. You have to calculate goodwill on the acquisition of Crotset in grommets. And how should it be accounted for in the consolidated statement of financial position of Hummings after translation? Include a brief explanation and calculation of how the impairment and the exchange difference on goodwill will impact the consol financial statements. Okay, so now please understand, my focus is to understand, help you understand how will the goodwill be accounted in case of a foreign subsidiary. In case of foreign subsidiary, how will the goodwill be accounted for? So now always understand, the computation of goodwill has a process that you have to follow. The step is step 1, compute goodwill in foreign currency, or you can say compute goodwill in functional currency of subsidiary. Okay, which is a foreign currency for the parent, Step 2, impair goodwill in functional currency of subsidiary. Step 3, convert all amounts to dollar using applicable exchange rates. Okay, step 4 is exchange gain or difference. Any exchange difference that arises. Okay, what is the treatment of this? So if NCI is at proportionate share method, exchange difference will go to fully to FCTR, foreign currency translation reserve. But if NCI is at fair value method, the exchange difference will be allocated to FCTR and NCI in the ratio of shareholding. I believe we have discussed this point as well. Come on, guys, please tell me. I believe we have discussed this point as well. Is it clear, everyone? Come on, guys, please tell me. Goodwill. Computation. Now, let us do that. Let us do all the calculations part. Investments. Chalo. Draw. Let me use different color now. Yes, not this one. I will use yellow. Hummings paid cash of $24 million. Now investment is given in dollar. So now first of all, I have to convert this to functional currency of subsidiary. 24 into, I have to convert it to grommets into 8. So I have to multiply with 8. Or I'll increase the space here itself so that I can write these figures here itself. So it is equals to, so this way we are discussing grommets, exchange rate, dollars. Okay, so 24 into 8. $24 into 8. 192. Okay, now investment is done. What else? Let's go further here. Come, draw this one now. Hummings has a policy of measuring NCI at fair value. The fair value of NCI on 1st January 2004 is $6 million. Again, dollars. So we have to convert the fair value of NCI. Also 6 multiplied by 8 is 48. It's 48. Now less net assets. So net assets, I believe, should be in grommets only. Since crotch set has a range of net assets held domestically and overseas, the fair value of the net assets will be determined in the local currency. Hence, the fair value of the sum of the assets has been determined in dinars and others in grommets. The total fair value of the net assets determined in grommets at 1st January 2003 is X4 is 43 million grommets. The total fair value of the net assets denominated in dinars is 50 million dinars. So we have to add both of it. 50. So in grommets is 43 plus in dinars is 50 million. In dinars it is 50 million. So we have to convert dinars to grommet. We have to convert dinars to grommet. Now see what is written. 1 dinar is equals to 2 grommets. So we have to convert to grommet. So what we have to do? Multiply. What would you do? Multiply. So 50 into 2 plus what else? What else? Excluded from this fair value of are several contracts. Excluded from this fair value are several contracts with the customers of Crotset. These contractual relationships prohibit the customers of Crotset from obtaining services from any of the main competitors of Crotset. They have a fair value of 15 million grommets. So it's like a customer relationships. It's like customer relationships of 15 million. So this is the fair value of the net assets in grommets. So how much is equals to 43 plus 100 plus 15 is 158. Is 158. So what is your goodwill on date of acquisition? Is equals to this plus this minus this. Is 82 is the value of goodwill on date of acquisition. Now is there any impairment minus impairment loss? Is there any impairment of goodwill that is given in the question? Just see. Yes. So it is decided to impair the goodwill by 30%. Now, so what is the goodwill on reporting date? It is equal to this minus this. This is the amount. Okay. Now what you have to do is you have to convert to dollars. So what is the exchange rate from grommets to dollars? By 8. So this will be by 8. Now opening rate, closing via closing rate, closing via closing rate, closing rate is 7. Now average rate is not, ideally impairment loss is converted using average rate, but average rate is not given in the question. So we can take in that case closing rate itself. So what is the amount? This divided by 8, this divided by 7, and this divided by 7. Okay. So now tell me what happens. Goodwill on date of acquisition minus impairment loss should ideally become the goodwill on reporting date, right? But what is it happening? 6.74, 8.2 means there is an exchange gain. Of how much? 8.2 minus 1.46 is the exchange gain that is there. 1.46 is the exchange gain that is there. Okay. So now what is the question asking you to do? So question is asking you to comment on the treatment of it. Comment on the treatment. Okay. So now let's do the comment. Let's do the comment. Okay. Goodwill should be reported in console SOFP on 31 December 20x4 at $8.2 million. Point number 1. Okay. Now goodwill impairment will be adjusted with console RE and NCI in the ratio of their share holding. So the journal entry will be to goodwill console RE NCI debit, credit. How much? This one, 3.5. So console RE will take its share. What is the percentage that we have? What is the percentage that we 80%, right? So console RE will take 80%, and this one will take to 0.2, 0.7. Okay. Now, then exchange gain on goodwill. Will be adjusted with FCTR and NCI in the ratio of their shareholding, and the treatment will be goodwill account debit to FCTR to NCI by what amount? 1.46, this into 0.8, and this into 0.2. Now understand one more point. On disposal of subsidiary, this FCTR will be reclassified or will be transferred to P&L. So this is what I wanted to discuss via this question. Is that clear, everyone? Come on guys, please tell me. Is that clear, everyone? Come on guys, please tell me. Is it clear to everyone till here? Come on guys, come on, please tell me. Anyone having any queries in this part? Because this is a very important part, and you can see ACCA is asking questions on this one. Foreign subsidiary is becoming quite very interesting topic, quite very you can say a favorite topic of the examiner. Okay, so we cannot take a risk in this topic. Okay, now so 19 is discussed, 20 is your assignment, and 21 is your question from discontinued operations and subsidiary, a mix of it. Now, though I just want to discuss one particular point from this question perspective. Okay, not the entire question, but just one particular concept, and you can solve this question as your assignment. Okay, now just a minute. Discontinued operations. Just let me help you with the understanding of the concept, and then we can discuss this. Okay, so now understand the concept. When a subsidiary is disposed of, tell me what is the treatment in consol P&L and in consol SOFP. What is the treatment? So in consol P&L, okay, we time a portion and do line by line consolidation till the date it was a subsidiary, right? Now in consol SOFP, we dispose of subsidiary and no consolidation of the subsidiary disposed of. In consol P&L also we recognize gain or loss on disposal, right? Ideally this is the treatment that happens, but understand if subsidiary disposed of is classified as discontinued operation, then Then what is the treatment? Then in consol P and L, we do not do line by line consolidation. Rather, for till the period, okay, profit till the period it was a subsidiary is recognized in P&L as a single line item as profit from discontinued operations. The ultimate profit amount will be same, but the impact is on the presentation. I believe this part is clear to all of you. This concept is clear to all of you, I believe. Come on, guys, please tell me. I believe this concept is clear to all of you. Now, let us solve this question. Explain to the directors of Sterling Company how to account for batch as a discontinued operation at 1st January 2009. In Sterling Consolidated Finances, your answer should include a calculation of goodwill at 1st January 2007 and calculation of how the investment batch should be measured prior to disposal. Okay, chalo. Now, this is question number 21. Let's read the question first of all. That is our duty. Sterling is preparing its individual and console FS for 31st March 2009 in accordance with the International Financial Reporting Standards. On 1st January 2009, Sterling Co. announced a plan to dispose of the batch company which operates in a significantly different business sector to the rest of the group. Plan to dispose of, it is classified as a discontinued operation. It will be classified as a discontinued operation. So now how to classify as a discontinued operation? Tell me. Following the principles of IFRS 5. How to classify as discontinued operation? There are two conditions. That is, the asset should be sold immediately in its present condition. Okay, asset is capable to be sold immediately in its present condition, and the sale must be highly probable. Okay, now for the sale to be highly probable, again there are 5 conditions. What are the 5 conditions? Management is committed to a plan to sell the asset, active program to locate a buyer, price should be reasonable, sale must happen within 12 months, okay, and there should be no change to the plan. If all these conditions are satisfied, we say that the asset is classified as held for sale, or the subsidiary is classified as held for sale. And if a subsidiary is classified as held for sale, it is a discontinued operation. Point number 1. Point number 2. When we classify it as held for sale, we say what is the carrying amount, what is the fair value less cost to sell, what is the difference. Okay, so if the fair value less cost to sell is less than the carrying amount, we recognize the difference as impairment loss. Okay, we recognize the difference as impairment loss in P and L. Okay, now, so that's what is happening here. Now, come on, please here, see here. Let's read the question further. First acquired the subsidiary 70% on 1st January 2007 at a consideration of 3.1. When the fair value of the net assets was 3.6. Ordinary share capital and retained earnings was this much, respectively. Excess of the fair value was due to a building whose estimated life is 10 years at the acquisition date. The fair value of the NCI was 0.9. So can you please tell me what is the goodwill on date of acquisition? What was goodwill on date of acquisition? Investment is 3.1. Investment is 3.1. Fair value of net assets is 3.6. Then NCI is 0.9. NCI is 0.9. So what is the goodwill? So goodwill on date of acquisition is this plus this minus this. 0.4 is the goodwill on date of acquisition. Okay. Now, please understand further. On first, this is happening on 1st January 2007. On 1st January 2007. Now on 1st January 2009, on 1st January 2009, it says reported a retained earnings of 2.9. So now tell me, what is the net assets? What is the net assets? Net assets will be equity share, equity share capital. How much? Let's see. 0.5 and 0.5. Retained earning will be how much? 2.9 given in the question. Now fair value adjustment on date of acquisition is how much? So if you see here, the question is giving you 2.1 plus 0.5. So carrying amount was 2.6. Carrying amount is 2.6. Okay. So now, so fair value adjustment on date of acquisition is 1. Now, so we need the net assets on this date. So now, if we have a fair value adjustment on date of acquisition is 1, there will be excess depreciation in post also. For how many periods? X7, X8, 2 years. 2 years. Okay. Now, Khushi is saying, sir, the plan doesn't say that there is a commitment. Yes, it doesn't say. But if you read the question, this part, Sterling company decided to treat batch as a disposal group held for sale. Question has already concluded that part. Okay. Question has already concluded that part. We are not required to evaluate whether it is a disposal group or not. Question has already concluded that part. Getting my point? Okay. Now, what is the net assets here? Net assets will be this divided by 10 years into 0 into 2 is excess depreciation minus. So the net assets on the date of planning is 4.2. Is 4.2. So now on, okay, understand, on 1st January 2009, when it is classified as held for sale, classified as held for sale. So what we do, we say what is the carrying amount of net assets? It is 4.2. What is the carrying amount of goodwill? What is the carrying amount of goodwill? Goodwill is 0.4. Since NCI is at fair value method, it is 100% full goodwill. We are not required to take notional goodwill here. Okay. Now, what is the fair value less cost to sell on this date? Just see the question. This part, draw. Okay, the fair value less cost to sell of the disposal group on this date is 4.4 million. Is 4.4 million. So what is the total? 4.6. So what is the impairment loss? 0.2. Where will this impairment loss of 0.2 be allocated? It will be allocated wholly to goodwill. Goodwill. Okay, which then will be allocated to parent. How much? 0.2 parent and NCI in the ratio of their shareholding. In the ratio of their shareholding. Now the answer doesn't stop here. Okay, so please first of all let me pass journal entry for this one. So to goodwill consol RE NCI, debit, credit. Okay, it is 0.2. Your goodwill will reduce. And what is the percentage that we had? 70-30. 70-30. So this into 0.7 and this into 0.3. This is the holding. Okay. Now this treatment was given on 1st January 20x9. Please make a note of it. Okay, please make a note of it. Now understand, guys, please understand that we are required to evaluate further. Is it the case? Are we required to evaluate further also? No. We need the treatment on 1st January 20x9 only. Fine. This is the answer. This is how we have to account for it. This is how we have to account for it. Okay. Now, sir, but this part which you explained was not tested. Yes, I understand. That's why I explained it separately. Because if it's a question of console P&L, then this part will be tested for. In my classes, I have always explained this part, and I believe you should know this part. Okay, you should know this part, and it will be of utmost importance in your understanding for the SBR. So I believe we have discussed all the questions which was our plan. We targeted for 5 hours, but I believe we are completing 13 minutes earlier, right? Around 13 or 20, around 20 minutes earlier, we are wrapping it up, right? But we have completed all the discussion of the questions. So now tell me, guys, are you feeling now confident? Are you feeling confident in group accounting now? Are you feeling confident in group accounting? Having discussed so many questions of conceptual but exam level. So now tell me, these questions which we practiced, are they just concept based? No. All of the questions which we have discussed, if you can see, they are exam past paper. See here, all past paper. See here, past paper. See here, past paper. See here, past paper. All the questions which we have discussed are the past papers, right? So we have discussed exam level questions. Okay. So now I believe you would have got a significant level of confidence. Okay. Now coming again to that point of one session wherein I will guide you how to write the answers in SBR. What are the tips and the tricks that you should use, or the hacks which you should use for time management and better answers in the case of ACCA SBR. So I'll be conducting a session, but if you want me to conduct after the session gets over, okay, please write in the chat box. Okay, please write in the chat box, sir, we want the session to be conducted. Okay. Now I believe all the students who have joined the session, they have enjoyed it. They enjoyed it to the fully extent, and you have learned a lot of concepts today. And yes, once the session gets over, I request all of you to drop a feedback, a genuine feedback in the comment box, which will give me also the motivation. Okay. So please drop a comment in the chat box. That's all for today. I hope you enjoyed. I hope you learned. Thank you, guys. Thank you. Bye-bye. Thank you, all of you. Bye.